Hi, everyone, and welcome back to the afternoon session on solar operations and asset management. I'm really delighted now to introduce our next panel. Moderator Kumar will be taking us through and introducing the various panelists, three of which will be joining virtually. I have warned Kumar that we do expect Q&A from the floor. And I'm also going to let you all know we looked at the agenda and realised there wasn't time for a break. So we are going to try and squeeze in a 5-minute break a little bit later on. So just to let you know that that's part of the thinking at the moment. So Kumar will be leading this panel on financing Australia's solar assets in 2021. If I can invite you to the stage, Kumar, and your panelists. Thanks, everyone.
Thank you for the introduction. My name is Kumar Parisetti. I'm a Senior Managing Director at FTI Consulting. I joined them very recently, about a couple of months ago. Prior to that, I was a partner at Deloitte for over 10 years, leading their energy transition practice. FTI Consulting is a global business with over 6,000 people, listed in New York Stock Exchange, headquartered in Washington. Our focus in Australia is threefold. The market design, our current market in the national electricity market was designed by grandfathers. Our grandfathers didn't anticipate the changes that we've seen in the technology and the take-up of the new energy technology. So there are lots of issues with the market. So we are hoping to work with the industry to address some of those challenges. Globally, we've got pretty strong market design capability. So that's one pillar. The second pillar is working with the new energy players and helping them build all the new energy technologies, including solar, wind, pumped hydro, battery, and other new technologies, including hydrogen. The third pillar is helping large incumbent players like Shell and other major players to transition into a new energy space. So that's us. In Australia, we've got about 260 people, growing quite fast. Thank you all for giving us the opportunity to talk about financing solar projects in Australia. It's a very interesting topic, and we couldn't have asked for a better panel to be addressing this topic. We've got, as Tess said, we've got 3 people virtually joining us. We've got Tobias Grimm from Munich Re. In Sydney, John Cole, the founder and CEO of Edify Energy, and Kim Nguyen, who's the head of Australian operations for Foresight Group. And with me here, Chris Toomey, head of operations for Elliott Power. I'll get them to do a bit of an introduction of themselves and their organization, and then we'll get on to the topic after that. Maybe start off with Chris, who is here in the room, and then we'll go to the panel. Chris.
Fantastic. Thanks, Kumar. Do you want me to turn this on? Yeah, great to be here, and thanks very much for hosting me today. So Chris Toomey, Head of Operations at Elliott Green Power. Elliott Green Power, we are a IPP. We own and operate around 300 megawatts of solar projects across Queensland and New South Wales. Whilst we're not a developer per se, we have been in the process of developing a number of storage and solar assets in the NEM. My role within Elliott Green Power, Head of Operations, I like to say I'm the jack of all trades and master of none, but covering everything from the day-to-day operations of our existing assets, as well as managing sort of the financing, both on the equity and debt side for our existing business. But yeah, great to be here. Thanks for having me, Kumar.
Thank you, Chris. Tobias?
Yes, thank you, Kuma, and hello, everyone. And sorry for not being in Melbourne on site in person, but I'm happy to be part of this panel. So I'm Tobias Grimm from Munich Re, and for those of you who don't know Munich Re, we are one of the leading reinsurance companies of the world. So we basically insure everything. Mostly we insure our primary insurers, so our primary clients. These are the Suncorps, IAGs, and QBEs and the like. So all the traditional insurance companies, but we insure also corporates and industries, and we are heavily engaged also in the renewable energy sector. And since the topic of climate change bears a huge risks for us as a changing risk, because we mainly cover accumulation risks such as natural catastrophes, and here we see an increasing trend. So energy transition and the low carbon transition is pretty crucial for us. And we want to enable the renewables industry, and that's why we kind of invented more than 10 years ago one product that should help the industry to get rid of crucial technology risks. That's the solar performance warranty risks, and that's in the meantime acknowledged as one major risk in the market, and we backstop that. So we insure manufacturers, and we take that risk also off from project developers and operators by taking also insolvency risks. And that's a bit the commitment where we come from, and I'm looking forward to the discussion.
Thank you, Tobias. Yeah, I'm going from left to right. John, you're next on the screen. Would you like to introduce yourself?
I couldn't possibly do that in the same room as Kim, so I'll let Kim go first. Kuma. After you, Kim.
Thanks, John, and thanks, Kuma. Thank you so much for having me on your panel. My name is Kim Nguyen, and I'm the head of Australia for Foresight Group. Foresight is a global fund manager across private equity and infrastructure. So we manage about $13 billion in assets under management for our international investors. We've got a global presence. We're headquartered in the UK with offices across Rome, Madrid, and Luxembourg, and here in Sydney as well. And we've been in Australia from the early days of solar. So since 2016, we've been investing here in solar in Australia, and we have 5 assets currently under management. We're continuing to look to grow our portfolio, both in solar and beyond. So very much looking forward to discussing this conversation around financing solar. Thanks.
Thank you, Kim.
So I'm John Cole from Edify Energy. I don't know if we're a developer. We definitely develop projects. We keep a minority interest in them, and we provide long-term asset management services. So we see ourselves as an IPP, but with sort of just shy of $1.5 billion of off-balance sheet financing. We have been involved in the solar market from the beginning, I think, including when Chris was previously at Arena. So we're involved in the first large-scale solar round and have continued to put projects away since then. We've delivered just shy of 800 megawatts of solar and battery projects. Got a big battery project in southwest New South Wales. It's in the financing process at the minute. We've taken sort of the hits that others have taken as well in sweating assets. We've needed to set up a registered, we're an exempt registered NSP for connecting the Gennawarra battery to the solar farm. We've had the privilege of having to procure and deliver synchronous 75 MVA of synchronous condenser capacity and understand the functionality of that equipment on the network. And we've also implemented artificial intelligence or machine learning to help us bid the assets into the market. And we've just recently got a development consent for a 1 gigawatt green hydrogen production facility. So we're looking beyond renewable electricity into the energy sector more specifically. And yeah, very happy to add my tuppence worth to the discussion today as to the challenges and opportunities. I think there are a load of opportunities that still remain in this sector.
Thank you, John. As I said, we couldn't have asked for a better panel to discuss the topic of solar and financing in Australia. We all know that our energy sector is going through massive transformation and transition. Predominantly, for 10 years ago, we only had coal and thermal generation with a bit of hydro, but it has changed quite a bit in the last 10 years, and it's continuing to change. We've got about greater than 20,000 megawatts of coal-fired power stations that are going to leave the market in the next 20 to 30 years. It has to be filled with renewables. So if we are just replacing electrons for electrons, we probably 60,000 megawatts of electrons, forgetting, not taking into account of all the additional demand that's coming through EV and hydrogen. So without that, just replacing coal fleet with new energy fleet, we need about 60,000 megawatts. So that's a lot of new capacity that needs to come into the market. And we all know that solar is the cheapest electricity generation source that's available. I saw somewhere that said, if we can harvest all the solar rays that are hitting the earth, just 1 day of harvesting is enough to supply our energy needs for a whole year. So that's massive energy available, but how do we convert that? And we humans, we've created lots of market design issues and barriers for harvesting and using that energy appropriately. If we manage to do that, then it'll be bonanza for all of us. So that's the potential is massive, but in the last 5 years, we've seen take up of solar, and we started in 2016, and then fleet grew quite fast, and also there's a lot of commentary around some of the issues that solar grid scale solar faced. Duck curve, we all heard about that. Rooftop solar cannibalizing grid scale solar, and also MLF issues overnight. Some solar panels lost 20% of their revenues overnight, just because some calculations identified marginal loss factors will have to come down. So there's a lot of future for solar, and someone said, yeah, future is bright for solar. So the question to the panel is, how are the next 5 years going to look like? So we've seen ups and downs for solar in the last 5 years. How do you see the next 5 years looking? Is it going to be bright? Are we still going to see some issues? How would you see future for solar? Maybe starting from Kim.
Thanks, Kumar. I think we all across the industry are really well aware of, like, there's a really near-term future, and then there's sort of like what you say, the next out to the next 5 years. I think, it's clear that in the next year, in 2022, that, with rising commodity prices and logistics, supply chain issues, that, we're seeing the cost of solar going up across the world. And, we're seeing that across our European projects. We're seeing that across projects that we look at here in Australia. So I think 2022 will be, a year where the market slows down a little bit. But then beyond that, out to the rest of the, 4 years out of the next 5 years, there definitely is a need for renewable energy. A lot of that will be driven by, state governments and their particular, regimes that they bring to market. And at the same time, I think when we think about the next 5 years, what we think a lot about is the interplay between government intervention with respect to coal retirement, and how that then plays into the renewable energy market as well. So, there's both push and pull sort of factors there.
John, as a developer and owner of assets, what are your thoughts?
Yeah, I probably agree with Kim's sentiments pretty much. I mean, for us, I think it's, from a development perspective, it's developing a generator that is immune to some of the shocks that we've seen previously. And so we bundle them into technological, operational, market and regulatory issues, and trying to make sure you change the shape of your generator such that it can still dispatch solar energy or produce solar energy, but it does so in with a different sort of combination of technologies, I think, or different technology choices. And so that's one thing where we see a load of opportunity, I think, to do something slightly different, because to answer your question, the next 5 years will look very different to the last 5 years, I think. So yeah, I still think we're going to have renewables. It's the numbers that you talk about need to come out of the system. We need 100% renewable energy grid, and it needs to remain stable as well. So how do these generators provide additional services to the network that haven't been provided in the past, and try and monetize them? So we're very big to try and end up with a solar generator that can have multiple revenue lines and not just be captive to the sent out solar times MLF times regional reference node price, either swapped with a contract or just merchant. So that's where we see the opportunity from our side. I think that there's still a load of potential left in the market.
That's good. Tobias, do you want to add to that discussion?
Yes, so a lot has been said already. Just to echo all the grid constraints, and maybe another thing that pops up more and more is the adding battery and storage capacities, all the virtual power plants that are already around, in particular in South Australia, but also somewhere else, that is getting more and more important. From a pure risk perspective, I guess we do have here that kind of market risks, and that's for us a bit difficult to help that really paving the way. We do have different legislations across states here, so that's not so easy from that perspective, because I feel a bit reminded to maybe some 10 years ago to European times, where we did have all the discussions around capacity markets so far, when already 20-30% in the system were already filled with renewables, with highly volatile renewables. So you need to adjust the market design and to the beginning on that, the grandfather's picture from the market design. And I guess that needs to be really adjusted to the needs of tomorrow in order to really pave the way for a 100% renewables here in Australia.
Thank you, Tobias. Chris, your views?
Yeah, I mean, one of the things we tend to forget about over the last particularly 3 to 4 years and going out into the future has been how well green prices have held up. Giving an indication that there is still a lot of, I suppose, pull factors at play to bring renewables into the sector, albeit we are in a very, very low energy price market right now, and obviously a function of quite a lot of overcapacity, particularly from coal. I think we're probably past the 5 years. I think we will continue to stay in that low price environment from an energy perspective as a solar operator. But as John pointed out quite clearly, you need to be flexible in your business plan. You need to be flexible in the way you design and operate your plants now and going into the future. And I think every solar operator, and maybe wind operator as well, are looking at their businesses and saying, how do I retain some flexibility? Because we are still in a pretty, I suppose, flux environment. But there are some, I suppose, green shoots on the horizon. And I think we're all of the view that coal's going to go out quicker than we hear in the papers. And if you understand that's going to happen, I think the horizon's looking pretty good.
Very good. Yeah, before I change the topic, are there any questions from the floor? No, no, nothing there. Good.
I'm happy to provide an example if just of the additional revenue line. So unfortunately, we ended up, well, we have a Genera solar farm, and it was in the West Murray zone. And there were a group of 5 generators, Kim's familiar with this as well, that were constrained off as to 50% of their capacity for months. I'll say 6 months, might have been 9, but it was an extended period of time. I've tried to erase it out of my memory, actually. And we had to go through an inverter tuning program there with AEMO and Powercorp. And one of the things we did was we took the lessons from that and then implemented a similar and not dissimilar tuning when Powerlink came into the market in March last year, where there was a declared system strength gap. And so we were able to say, well, hold on, we can actually change. It is one of the power of power electronics, that inbuilt flexibility that your kit is essentially reprogrammable, that conventional generators do not benefit from. It's sort of like the EV against the internal combustion engine. You can upgrade your software on your EV, and the Tesla is a better model in 2 years' time than the one you bought, or your iPhone, or whatever analogy you want to draw. And so we could basically reprogram, retune the inverters such that they could provide the system strength benefit to the network we probably horribly undercooked from a value perspective what that benefit was to the network, but it was implemented really quite quickly. It saved tens of millions of dollars of additional capex needing to be brought to bear. Call that a synchronous condenser. And Powerlink were really, really happy sort of with the outcome. I think it exceeded a lot of expectations. Now that's just one little example. I see a whole host of those examples sort of materializing as this transition sort of continues, and we've only just scratched the surface on the power of these power electronic inverters.
Yeah, no, that's very useful. So maybe I'll give another example that is looking at it from the market design perspective. So network constraint management. When we first designed this market in the mid-90s, Australian name was very unique around the world. People try to capture the cost of network constraint. What happens now in Australia is that we will say we'll constrain off a generator and don't compensate the generator. It was okay because those days constraints were not that big, but as a solar player or wind player, if you get constrained off and you don't get paid, you don't capture the cost. This didn't happen. This is not how any other market is designed. It's very specific for the name. Now people are saying, okay, is this the right way of incentivizing renewable players? We modeled constraint costs. In certain situations, a solar generator could be constrained up to 90% in 10 years' time. So that is huge error we made when we designed in 1995, 96. So those things are coming out to light, and those issues will be addressed hopefully in the next couple of years or so. Changing the topic, keeping around the same time frame, looking at it from a financing perspective, do you think that financing risks are likely to change? How do you see the financiers looking at the market in the next 5 years? Will they see risks to be different for a greenfield versus brownfield investments versus the existing projects if they come back into the market for refinancing? Chris, do you want to start thinking about that? Would you like to address that? And then we'll go around the room.
Yeah, sure. Thanks, Kumar. Look, we've been in a bit of a fortunate position. We're now in our third round of refinancing over the last 4 years. So we've had the fortunate opportunity to see how the banks have evolved over the last 4 years in terms of the way they're looking at solar. And I think one of the real key things that we're starting to see bear out in the way I suppose the banking market in particular is looking at solar is some of those risks around MLF and constraints and those sorts of things are now relatively well formed. The views on it, the way to price it, the way to deal with it is pretty standardized across the market. In the past, we had a lot of different views from different banking groups about how you would look at MLF events or DLF events or constraint events. And we're starting to see a lot of alignment across bank groups. The interesting thing is we see still a lot of disalignment between the way they look at long-term price forecasts. And irrespective of how well contracted you are in the next 10 years, most debt facilities are pushing out into those back-end years. And every bank will have their own view on break-even prices and the way to calculate those break-even prices. And it becomes really quite challenging to find a way to get alignment. And suddenly DSCRs don't matter anymore because that's all they really care about. So we're still seeing a fair bit of flux between the banks in terms of where their appetite for solar are. Some are very much on the more bullish end. Others are on the more bearish end. But then the ones that are on the bullish end tend to be a little bit harder on you around terms and conditions, want more rights to, I suppose, lock you up if something goes wrong. So we're still seeing, I suppose, debt to leverage ratios at reasonable levels and still seeing a fair amount of capital being provided from the banking market and margins coming down, but still a lot of disaggregation between the banks in terms of how they want to approach looking at solar in the long term and how they want to approach appropriate pricing as well.
Kim, what are your thoughts?
Yeah, absolutely. I would definitely agree with Chris on his thoughts there. We've also having assets that are a bit more long dated, have had a, you know, we're speaking to banks in refinance, and what we can say is actually margins have improved in the market, and that's fantastic to see. And I think, you know, that real driver is coming from that, the capital for sustainable investments, right? So across Europe, you're seeing that both from an equity perspective, like the volumes of capital flowing into ESG have increased enormously. And that's the same thing for green bonds. And that drives a lot, you know, that drives like the appetite for financiers as well to be financing things like, you know, solar farms. So yeah, we're definitely, you know, I think that there are, you know, definitely some tailwinds for us with respect to the bank financing market and their appetite for renewables in Australia. And like Chris said, you know, a lot more of the risks are known risks as opposed to maybe 5 years ago when some of those risks were a little bit less known, right? FCAS, things like that. But those things now have been recognised. I think forecasts have stabilised a little bit more, and then that therefore drives more confidence in the banking market.
So Kim, you have offices in Europe. In some cases, Europe is a lot more advanced when it comes to financing. So what sort of lessons do you think we could learn from Europe?
Oh, absolutely. I think we've always been really focused on clean energy. So about 80% of our assets under management sit in the clean energy transition space. So we've watched the clean energy transition occur in Europe and in the UK in particular, where, you know, it was 3 decades ago where they had the same level of coal-fired generation that we have in Australia today. And, you know, last year, coal-fired generation was about 2% of their generation mix, you know, and that shift has really occurred over in Europe. I think, you know, the lessons that we learn is that, you know, there are obviously key market changes, regulatory risk to look for as, you know, as market transitions, but at the same time, it's all about the opportunity, right? It's the opportunity to invest in the space. The fact that we have a vacuum in terms of how that generation is going to be created in terms of as coal-fired generation retires, that creates investment opportunity. And at the same time, there's a lot of capital floating around in the world where, you know, there are still lots of negative interest rates across a lot of countries. So there's a lot of low risk capital that's looking for a home. And, you know, I think in Australia, it's clear that our renewable energy market is higher risk than the European energy market, but you are rewarded for it. You do get a higher return here in Australia than you do in Europe. So there is a reward here in Australia for accepting that high risk premium. I think the opportunity for Australia is really about our ability to reduce that risk premium here and to be able to drive in more capital, and also effectively to lower electricity costs for consumers by, you know, by taking unnecessary risk out of the system.
Very good, thank you.
Do you have a view, Kim, on the greenfield v brownfield question, like the financing of build as opposed to built assets?
Yeah, I mean, there definitely is a risk premium now in construction, and in particular, EPC contracts push that big risk back onto equity. So, you know, previously you would be able to find a contract where your contractor would take that risk, and now very much that's equities risk. So that's something that needs to be priced in. I think in particular, you know, that I think for us, that's a risk that we're willing to price and that we're willing to participate in. So we're very interested in greenfield assets.
Yeah.
John, your thoughts?
Oh, look, what do I think? I agree with Chris. I think you pay a lot of money. I don't know who's in the room. I don't know which Aussie bank is there. I'm not about to insult in the room, but more on the line. But you pay a lot of money for market forecasts, and they're used as a sensitivity. So, and our experience that lines up with Chris's is that debt is sized of a break even that's relatively arbitrarily chosen by different lenders. So that can make it hard to harmonise. I think we're one of the areas where we've seen, you know, on a bright side here is I think we've seen very good support for the LGCs. So I think LGC spot yesterday was $42. If I went back and looked at some financing models from 4 or 5 years ago, I would say that we'd be in a single digit, if not low double digit market there. We're seeing a load of voluntary surrender of LGCs. There's talk of, you know, the fungibility of them with ACCUs and the whole decarbonisation thing. So I think that's a very good thing, and that only helps from a debt and equity perspective when it comes to capitalising these assets, because the LGC market hasn't, and there are a whole bunch of reasons, it could be a whole separate conversation, but it hasn't sort of collapsed the way that was envisaged previously. So I think that's a good thing. And then I think on the contracting side, you know, good projects beget capital that you sort of finance. You finance projects, you also finance revenue contracts. So there's the lengthier contract. And then on the build side, I think we're starting to see something that looks different to just a straight vanilla EPC sort of wrap. It's which parties are best placed to manage the different risks. And so you've got in Greenfield your ability to construct the projects, and we had the unfortunate situation. We're in the unfortunate situation of having RCR collapse, and we had 5 projects that they were the build contractor on. Thank goodness they were all mechanically complete at different stages, actually. And then there's the connection risk. And so that is the biggest risk, and who's best placed to take it. And I think the world has moved on a little from that being your build contractor. And so coming up with a smarter multi-contracted package, but net, it has a lower risk profile. I think that's something that's evolved, and it has taken, will continue to take some debt and equity investors or capital providers. Just need to get their head around. It's taking a little bit longer to get their head around, because it's easier if you've just got a vanilla wrap, one throat to choke, as they say.
Yeah, and that's probably something which you can see in the banking markets in Europe, that they're way more open to EPCM than the Australian banking market, which has traditionally been an EPC market. But as in solar, not so much, but for wind in particular, as you're starting to have OEMs pull back from providing EPCs and moving more towards an EPCM model, you know, we'll certainly see the banks being pushed and challenged to sort of accepting and pricing that EPCM risk.
And then your question to Kim, Kumar, I think there are a whole bunch of provisions we could go through and say the European standard is a much simpler arrangement than what the traditional Aussie banks look for. There's a bunch of things that come to mind. Equity cure is probably one of them. And what is typically asked for in Australia is markedly different from the European perspective. And the sooner we can try and end up with, if we want to take cost out, like project financing is a very, the capital, it's cheap debt capital, but the friction involved in getting it, we could make that a lot more, have less friction and make the transaction costs lower. It's a more homogenized sort of documentation across groups, as opposed to feeling like you're creating a tailored financing package on every occasion. I think there's leads there that are coming from Europe at the minute.
Yeah, very good. You mentioned that you know, different banks have got different threshold pricing. Isn't that a good thing? So wouldn't you be shopping your project to different banks and say, hey, whoever has got the highest threshold, lend me the money? Isn't that a good thing, Chris?
Yeah, if they were upfront from the beginning about what that threshold was. Look, it's unfortunately the banks are not necessarily all aligned on this point, and as is anyone who's worked on a project financing with a club of banks, they all seem to run to the lowest common denominator anyway. So you could start off with the highest one and want them to come in, but as soon as you bring more banks into the equation, they all seem to go down to the lowest level. So yeah, I would like it to be in a position that I'll say, well, Dave over here is doing it, so why don't you all follow him? But unfortunately, that's not the reality.
Very good. Sorry, I didn't get your views.
Yeah, thanks, Kumar. No, I'm really keen to hear the thoughts also from the other panelists, of course. So the only thing I would like to call out is just having a stable and reliable environment where we as a potential investor would feel as comfortable with. So we are not only an insurer but also an investor, and I mean, we have undertaken all that efforts in other markets as well. We are invested in many European countries as well. And as rightly has been mentioned, there is an oversupply of capital right now in the chase for the good projects, and we do have lots of issues in Australia that needs to be tackled, starting with that kind of connection risks. So this is unfortunately something where we cannot really help the market to get rid of these kind of risks just because they are not measurable for us. We love it to take some kind of technological risks away, because this is something what we can model, and we can really monitor how to deal with that. Political or market risks is of course something that's pretty hard for us.
Kumar, just one more point from me, and I think it was one that maybe Chris and Kim made, but I think the advisor market as well is a lot more mature. So, and I think even on the connection side, and there's more less unknowns or whatever Donald Rumsfeld would say, but yeah, there's more maturity across the board, which sort of helps. Particularly in the advisor world, be that legal, technical, financial, insurance. Yeah, exactly. Yeah.
Any questions? No? Yeah. Moving on to innovation. So solar sector has been a disruptor to the energy sector. We've seen massive amount of innovation and invention that came in, brought all the costs down for solar. Are we seeing business model innovation in solar? If so, what sort of innovations have you seen in Australian market or in global market? Starting with Kim.
Oh, okay, fantastic. Innovation, I think the way that we think about innovation for solar is, rather than just taking a solar plant by itself, it's very similar to what John was saying, is like, how do you think about it within a portfolio? And that portfolio can be a physical portfolio in the sense that you hybridize your site and you put a battery on site, or that you, from an equity perspective, that you hold a portfolio that sits across solar, wind, batteries, etc. And I think there's a real de-risking that occurs when you hold a diversified portfolio. So we've conducted studies, in particular for our assets over in Europe, that sort of show a negative correlation between wind and solar. And so therefore, when you put them in a portfolio together, you actually, there's a natural hedging that occurs amongst those assets. So we see it as that. It's sort of solar, but it's sort of stepping back and saying, in the bigger framework, how can you make solar work with all the other tools that are out there at the same time.
Good. John?
Oh, look, I think I agree with Kim. I think there's no doubt that there's portfolio benefit. I mean, we've got four different equity owners across the portfolios that we manage, and if they were all in one party's hands, you could see that you would get more synergy out of them than being separated. So I think it's a bit of a no-brainer. It's just on solar. We do see the benefits with storage, and we can see it combined with wind as well. So I think where we are seeing innovation is really just around in this evolution, this technological evolution. And so how do we combine different technologies? And we're talking about battery storage, that's lithium ion. I think we're seeing vanadium flow or redox flow batteries will be around sooner than I originally thought, actually. And we try and get ahead of that by making sure that different kit is provisioned in our development approvals. And then, on the inverter side, people call them grid forming. Are they grid forming? Are they grid strengthening? Is it just advanced? Who knows? Who cares? Can you truly form a grid on a 275 or 330 kV network? Probably not with one generator, but they do have different characteristics, and they're more sympathetic generators to connect to the network. So I think it's that whole package and how that works together and what your use cases are. I mean, I think from our perspective, we're seeing more direct connection between, say, corporate off-taker and project than we have in the past. So a lot of things are being intermediated with off-takers primarily being the retailers, but not just so the corporate PPA, but that looking at exactly what is the output profile from your generator and what's the use case of that. So not just financially, but physically, the linking of those, the generation and the demand side. And that's interesting. I think we're going to see, is hydrogen a vehicle or a chemistry for long-term energy storage? How's that going to go against pumped hydro? I mean, that's just another outside of solar, but it's, one begets the other, right? These battery technologies don't actually create, or storage technologies don't create any energy. And so here we are. That's why I still think solar is a good play from a cost perspective, a reliability perspective, the P90 to P50 ratio spread and stuff. And it's it's a proven technology, and we do need more generation. So I think it's how the innovative side for me is how it works with other technologies, and you package that up, and not just from a generation perspective, but linked with the demand side.
Very good. Tobias, would you like to share?
Yes, I mean, innovation is a good topic. Maybe it's more an evolution rather than a revolution, but we see a lot of different trends, and a lot has been mentioned already. Of course, the combination of solar, wind, and batteries into an integration is something that will become more and more prominent. We do see also new battery technologies. That's also an interesting part of the story. And of course, hydrogen could be a game player in case we just manage it in Australia to create an environment that is really able to scale up green hydrogen, because then the amount of green electricity will be increased dramatically. But on that end, we do have some regulatory and legislative boundaries that needs to be considered. Off-taker risk is something that is very important. And we do see also lots of innovations on the small scale side. So just many startups, new technologies, new batteries, all the decentralized but organized networks in that virtual power plants. That's also something that is very promising, that could help us just to overcome that baseload issue. That's what one electron of renewables is not really able to contribute to. So within an organized system, it is of course supportive.
Very good, Chris.
Yeah, John touched on an interesting point there around bank debt. It may seem cheap, but the friction that's involved with dealing with banks, particularly when things go wrong, can be quite a large challenge. And people often forget that we run power plants and things do go wrong. And one of the, I suppose, innovations that sort of we brought to the market a little while ago, and we're starting to see a little bit more appetite from that, was sort of starting construction on a full equity basis. And we've seen some of the benefits of that, of not having to deal with lenders and not having to deal with decisions by committee as you go through construction on these types of assets. And I see a few nodding heads. Construction on renewables assets, things do go wrong. You don't get everything right. But if you're not having to go back every week and get approvals from banks and having to deal with all that sort of stuff, it does slow things down. And having the ability and flexibility to full equity fund construction, we're seeing a lot more appetite for that and a lot more interest in that sort of process. And then obviously bringing the bank finance in at the end once the assets are de-risked and the construction is de-risked. So we do think we'll see a little bit more of that coming out in the market as people realise that actually construction does take time. You need flexibility. And sometimes banks just aren't the best partners in that sort of environment to provide that level of flexibility.
Thank you. Any questions? No?
Chris, I think, just while somebody in the audience is going to have their courage to throw their hand in the air.
Yes, they are.
I think excellent. Chris, I think that's a sign of evolution as well, or maturity of the sector. Banks are very good at assessing risk. They're very good at panel beating contracts. Right, and they can help get sectors like this started, and then when there's levels of confidence, equity can come in, and if they've got the firepower, take some of those risks themselves, and then look to refinance once you're through that early stage of construction.
Thank you. Got two questions. Yeah, go ahead.
Thanks very much. You can hear me all right? Yeah, hey, it's Adam Bumpus here from Redgrid. Thank you guys. Really interesting discussion topic, but it really super interesting on innovation and how can we innovate around the financial mechanism of how does capital get deployed. And I'm wondering, do you have any comments on where fintech is in this to help this happen? So we see fintech, decentralized finance, crowdsourcing finance, all that kind of stuff. Is there anywhere that you're seeing new innovations coming over the horizons that standardize that, make it a little easier, perhaps not having to worry about going to large scale banks anymore because communities are funding themselves through a systematic way of doing that? Any ideas on innovations coming down the line?
Did you hear that question, panelists? Is there any innovation in fintech? How is innovative fintech being used in financing grid scale projects? I've seen innovation in community type solar and battery projects, but I haven't seen anything in the grid scale. Have you?
Yeah, Kumar, I would definitely agree with that. I think, the size of the finance at the moment in those sort of fintech markets that they're raising only supports like smaller community sized projects, as opposed to, where we see projects are going, which, you need to be upwards of 100 megawatts at least to sort of get the right economies of scale. They're not currently at that ability to finance that level. So, our preference would always be to work with the traditional lenders in space.
Thank you. Yeah, there are no more questions. I've got one final question before this one more. Yeah, sure.
Hi, Danny here from AC Energy, developer. Probably a question for John, if you don't mind, because we're talking about curtailment, West Murray Zone, and potentially what we're looking at the minute is a lot of independent BESS projects being developed and ready to be connected in the next few years. Do you think that's a solution for the current projects that are commissioned, or do you think it's worthwhile them guys actually looking to introduce a BESS project for their project too? So to kind of have a wind plus battery or solar plus battery on site instead of relying on other developers to, develop these projects independently.
Yeah, look, I think I've got your question. I'll answer it with an example. We very much have a view that we'd like to be the masters of our own destiny as much as possible in development. And so an example I'll trot out is we think relatively late in the day, the NSP probably has a different view, but we were needed to procure the two 37.5 75 MVA synchronous condenser capability for the Darlington Point solar farm, and that is located circa 400 kilometres away from the site. And that just added a load of complexity, another dependency. It's outside your generator fence. It was an additional risk that could impact the start date of your revenue line, et cetera, et cetera. And so what we're trying to do is develop a generator that everything that you need is inside your generator fence. So if that's your solar farm fence, inside that, a wind farm fence, whatever it is, but you look after yourself, you're not dependent upon a network company to operate or be involved in the provision of other services that helps you get through your FIA. You want to design your generator, so it's your design, your project, you deliver it, and it fits all the requirements you need, as opposed to being conditional upon somebody else doing something else. So in the West Murray Zone, I think it's a topic of itself as to how we ended up there and where fault lays and stuff. But I think it's just a very congested part of the network. There's more power trying to come in from northwest Victoria into where the load centres are, through the rhombus of regret. I think it's been called, even rhombus of death. I think that's a bit too emotive, but the rhombus of regret. So I think you need to look after your own project, really, and hopefully you'll be additive to the system strength or reliability or resilience of the network. And if you're not, then I think you end up needing to supplement your generator, your project with dare I say, other synchronous condensers or services provided by a third party.
Do you think it's the most economic solution though, John, for everyone to look after themselves?
Yeah, I do, because I don't like dependency, and I think that as you look at the way this market's going to evolve, I will make a prediction, right? What's my view? I think these generators will create half their revenue line, plus or minus a bit, from provision of services, not just the sale of electrons. And so you give up a lot of that optionality in going forward and functionality in your generator if you hand it off somewhere else. And then the other thing is, no disrespect to any NSP in the room, but as soon as you're in the hands of a monopoly, it always gets tricky. So yeah, we'd rather for those reasons try and provide bring the solution to the table ourselves, and that's what we sort of set out to do.
Chris, you're building batteries yourself. Would you like to comment?
Oh, look, I think John, Kim, and touched on the point, and I think when you look at the solar assets themselves, you got capacity factors in the best instances of above 30%. So from a technical perspective, you've built these giant, I suppose, connection assets, which are really underutilized. And we sort of 18 months ago, when we were looking at batteries, looked at standalone versus co-located, and touching on some of the points that John's already raised. But just the fact that you can utilize an asset you've already paid for, you've already spent the money and the capital on, and not having to spend that money again makes a large difference. And as we've seen the Queensland market evolve and more solar come in, we see a really strong negative correlation between the revenue line on a battery and the revenue line on a solar asset. So we're pretty excited about that from our business perspective, and running that across all three of our assets at the moment. From a regulatory perspective, I can't say it's easy. It is challenging, but as John pointed out, it's nice to have the control in your own hands. Being master of your own destiny in this space is a lot better than being at the whims of other regulators and regulated entities.
It's a good chart, Chris. I've forgotten about that, but we used to talk about, you pay for your grid connection 24/7, but you're going to use it during daylight hours. It was back in the UK. So yeah, how you harness those sunk costs and try and create some benefit out of them. There you go. There's innovation just on its own.
That's very good. So we are almost there with time. Oh, we've got a question. Yeah.
Yes, I do have a question.
Sure.
My question is to Kim.
Give you a microphone and a warning. Last question. We're going to wrap up.
Thanks. My question is to Kim. You made the comment about Australia being perceived as a higher risk investment environment than Europe. Can you explain to an ignorant sort of person why that is?
Absolutely, and no question's a bad question, so thank you very much for it. One of the key reasons is that renewables in Europe tend to be subsidised. So they'll, in France, for example, there's a solar feed-in tariff. In the UK, that there was a feed-in tariff for a long time as well. So it's more so I think it's around the revenue structure, although we are seeing in Europe very much a movement towards unsubsidised solar. So, that's one area. And then the second area, it's mainly around grid risk. Europe is a much more integrated grid than what Australia is. We're effectively just one long skinny line with little bits coming off it. While Europe is a grid, and it's interconnected, and therefore that just means that the grid risks around connection and around ongoing operations is much lower in Europe. And then I'd say the third point is probably around market volatility in terms of power prices. Is that there's probably been less volatility over there than there has been here.
I think that's a function of energy-only markets.
Mm-hmm.
Yeah. Thank you very much. Can I please get you to put your hands together for the panelists? Thank you.
Thank you very much. It's always difficult not being in the room.
Thanks, Kumar.
Absolutely. Thank you also from my side.
Cheers. Bye-bye. I think we might be talking just to ourselves.
Yes. John,
I think I've hit the mute button.
all good. Greetings to Brisbane.
Have a good day.
Lovely
Bye-bye.
to meet you, everyone. I think that was a really fantastic presentation from the panel, and indicative of the number of questions I'm sure they were still coming. I'd really like to welcome our next keynote speaker now, Gail Young, who is very well qualified to talk to us today, having a double master's degree in PV engineering as well as in technological innovation. So those innovations just keep coming today.
No.
Oh, you didn't?
I'll be talking to us about solar trackers architecture for the next training.
Morning. Who is this keynote person?
Good afternoon, everyone. My name is actually Yang. They put the, it's all right, they put a surname in the front, but that's fine. Yeah, doesn't matter. I think many people has already known me. I have like a double identity today. I'm also helping organize the events, and now I'm contributing this presentation on behalf of ARTEC. So I really just had like very limited time to prepare in this. I'll try my best to do this as fluent as possible. Okay. Yeah. So first, I'm very happy that my keynote is in between the financing topic and the ROI, because my study here will be somehow related to that one. So it's not like a product sales pitch, but it would be more like a knowledge sharing of a very recent study we have. All right. So first, this is supposed to be like a little artwork practice. So previously, I would just want to invite someone to draw a tracker, but probably I'll just do it myself. So if you're going to draw to have like a tracker in your mind, what will it be? I believe most people will maybe have like, say, a motor in the middle, and then a very long torque tube get across, and you have like the both wings. That's the solar panel. And the post, right? Module post. Okay. That might be a solar tracker I believe in most people's mind. Here I have a better one. So if that's the tracker you know, then that's the tracker has been outdated. So tracker technology has changing, but I think not as fast as module. So let's have a very quick recap for the tracker like technology roadmap. So like before 2010, no one knows what's the best technology for the market. So there are like multiple early technologies, including like dual axis trackers. And then somebody find a way, like single axis trackers has the best LCOE, just like mentioned by Andrew this morning. Yeah, and that's led by Array Technology. And then we have Nextracker, who find out that the single axis tracker is maybe, I don't know, even better, or maybe have like a higher market share. But still, this kind of tracker have some problems, have some like I wouldn't say problem, I feel like challenge. It's single point drive, and it's a flexible structure. And now we are in the period of time of transforming to most updated technology called synchronous multi-point drive tracker. Too many words. I normally say multi-drive tracker. So it's a rigid structure. The background for this is simply because of the increasing size of solar modules. So you can see that in the past 3 years, solar modules are getting bigger and bigger. We are entering 700 watt, likely next year for each module. And the module height is like 2.3, 2.4 meter high. And the impact on tracker is basically the dimension. You're gonna have longer tracker, higher tracker, and it's wider, the cord. And this has increased the instability for tracker design. Let's keep going. I believe many people have heard about the wind tunnel test. I know many tracker company, they said, okay, we got this wind tunnel test report, so we are bankable. No, not really. Wind tunnel test is not a quality test. It's just a test to collect some design coefficients and understand the design behavior, like the tracker design's behavior. So this is our multi-drive tracker being tested in the CPP Wind Engineering Lab at Sydney.
All right, I don't hear you
so
in presentation, but
share a bit more.
like everything is okay. Yeah. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
So let's take maybe that triangle one, for example. So you can see that there are like a tilt angle at the axis, like the bottom axis. So that's like tilt the tracker at like say 42 degree, 44 degree, and then they increase the wind speed in the tunnel. And once the wind speed reach that dot, the tracker becomes so deflated and maybe got damaged. And when we do this test, like so many times, we get so many dots. Yeah, sometimes even under the like the same angle, like the destroying wind speed might be slightly different, but there is a bottom line. It's this black one. So this one has been optimized somehow. The more natural one is like a V shape. So which means you can never have your tracker stow at 0 degree. So at a certain wind point, for example, here, it's stow, you can see that dash line, stow wind speed. So under that dash line, that's the safe zone. That's the tracker can do full tracking. But if the wind speed reach that dash line, your tracker has to go to a certain stow position. And in this case, it has to be nose down towards the wing, like the illustration on the right-hand side. So here you can see that the safe zone is on the left, is over here. For this one, let's assume like a 30 degree, nose down. But what if the solar module is getting big? You have like a very long tracker. That curve will come down. That will narrow your operational wind speed range. So you only have maybe, say, 12 meters per second, like a sort of wind speed thresholds, and you must stow your tracker at a steeper angle. Can somebody tell me what could be the risk for this? So there are like 3 risks. In one word, it could be either get easy to swaying, we call glapping instability, or trembling, or because it's big, the wing pressure, you might get like a panel crash or micro crack in the panel cell, whichever. But with the multi-point tracker structure, we got this. So this is like the V upside down. So for the first time, we can safely stow your the tracker at a 0 degree stow position, and we enlarged the operational wing range. So we are at this direction, and we increased our stow wing speed to more than 20 meters per second. And I believe Trina Tracker, PVH, we are all at the same like path. And no wonder Array Technology, they acquire STI Nolan, they also want this kind of technology in their portfolio. But I'm proud to say that Artec Solar, we are the first company who launched the multi-drive point tracker in late 2019. On the bottom right, Sky Smart 2, that's our first multi-drive tracker. That's a 2P tracker, 4-string tracker. And just last month, we launched Skyline 2. So which is our 1P multi-drive tracker. Okay, here is another, why the color has changed. Okay, never mind. At least you can see the numbers here. So here we do a case study for like a virtual projects in Texas. And we are comparing different tracker with like different stow parameters. So obviously we have Skyline Sky Smart 2, and we have the comparison model ABC, which is representing maybe a well-maintained traditional tracker, still stow at 30 degree, 16 meters per second, like stow wind speed, or the flexible traditional tracker, maybe it's equipped with a large module and doesn't do any other like arrangement, or the worst scenario, 45 degrees stow tilt, tilt and 12 meters per second. And this is the wing profile of the site. So we only have the 1 hour average. So we have to use the dust curve to do some transformation. between the 1 hour average and we want to use the 3-second wind gust measure at 10 meter height for like it's like a stick stow wind speed. Okay, right here you can see that I put some dashed line that represents the equivalent stow wind speed for the 5 groups. So let's take maybe the model C, for example, the worst case. So for model C, you can see that every hours on the right-hand side of the dashed line will be the time that the tracker has to stay in the stow position. So the tracker is not tracking, but has to do either this or that, either west or east. And I believe solar people, you must be very familiar with this chart, like the bell shape. So the dark, I think the can you see the light gray clearly? That's like the wind speed at the back. I think maybe it's because there's some changes here. I don't know what happened. But anyway, the dark blue represents the full tracking. If you are doing PVSys or any other sort of simulation, you can easily get this chart, like a production curve, the hourly curve, but that's not 100% true. I'll just give you some sample here, and then we would do some like modification. So this is for Skyline 2, and the red dashed line represent its critical wings. It's stow wind speed thresholds, and in that day, no wind speed has surpassed that dashed line, so that's good. The Skyline 2 production perfectly matched the uninterrupted tracking curve. SkySmart 2, it's the same. It has like 20 meters per second stow wind speed. And let's see model A, that's 16 meters per second. So you can see that after 3 p.m., the tracker needs to get stowed towards west. Luckily, that's west. So there's like not much energy losses. You can see the energy losses in that shading area, the blue shading area. Let's see another worst case. That's a 14 meters per second. And sorry, I forgot to mention, the wind direction between 1 p.m. and 3 p.m. actually turns to east. So the tracker has to face like another side. So you can see there's like a big gap there. And that's a worst scenario, a 45-degree tilt and 12 meter per second stow wind speed. So there will be more energy losses because of the steeper stow position and say like the backing back to the sun direction. And here we have a conclusion in this table. So as you can see, we have the stow hour in total, and model C is the worst. There's like 1,300 hours approximately, and they are causing up to 4.17% like energy losses. If we translate that into a financial loss with $28 per megawatt hour, that's 260,000 per year. Here I have another chart. I call this one chart to tell all stories. So you can find all those 5 groups in this chart. But if you are having like another tracker with like different stow position, different stow wind speed, we can find the actual, not actual, but you can find like the simulated energy losses from this chart. And here is another table showing some financial comparison. So let's look at maybe column 2, the project B. You can think it as like the project, the base project, or the project that used the model B that I just shown before. And the wind-induced energy losses has been included. So you can see the first 3 line, it's 100 compared to the project SL2, the Skyline 2, it's the same size, same investment. The investment has already included the ICT incentive from the US government. And let's check the first year. Obviously, it's different. And down at there, the project IRR. I don't know why it's that low, but let's just trust this figure for now. And then you can see that there's like a gap of 0.18%. And if you look at the difference for 30 years net benefits, yeah, that's like 2.7 million. Okay, what if we do some improvement or maybe lower down the cost for the project B? You can see there. Let's try to reduce the EPC pricing maybe for 1.3 cents per watt. Okay, the IRR match, but still they cannot like fill up the gap of the loss unless they increase the scale of this project investment. So which means if you're choosing the wrong tracker, the other tracker, they will have to reduce their price by 1.3 cents per watt to match the multi-drive tracker. And there are some few other like relevant costs we didn't put in here, like installation and other stuff. Right. Okay, it has the background now. I wish I have more time to introduce this. So Skyline 2 have 5 innovations. For example, like the pentagonal torque tube on the left-hand side here. On the right end, modular design. Yeah, modular design is like for the first time you can design a tracker as playing Lego. You can just stack up easily without having difficult say different what per watt pricing. It will just keep the same. In this page, I just want to show you our existing projects and the projects in pipeline in Australia, and we have a demo projects and training center in Melbourne. And everybody's welcome to visit this demo projects. Our first visit will be this Friday. If you are interested, please come to me. We have 3 trackers established there, including the SkySmart 2. And I would like to finish my presentation with this snapshot. Everybody please just read by yourself. And if you have any questions, feel free to ask me. Thank you.
Any questions from the floor now, or?
Hi, thanks for the good presentation, Yang. It's John from Terabase. Quick question on the, so when you're calculating the wind speed and you're doing the financial analysis, are you basing it on the entire site going into stow position, or are you assuming it's a large site and it's just certain areas which are going into stow?
It's a kind of simple financial analysis. So I assume the entire size goes to the stow position. Yeah.
Okay, asked and answered. Very efficient. Now we are running a few minutes behind time. So thank you very much, Yang, for your presentation today. And I'm sure there'll be some follow-up conversations as well. I love a site visit, so I'm going to try and find an excuse to come out and see the demo. Yeah. We are running 5 minutes late, but I would like to suggest that we just take 3 of those 3 extra minutes now to stretch legs, use a bathroom, check your phone if you need to, because we have 2 really interesting panel presentations coming up. And I think I'm happy to reduce my time closing up from 5 minutes to a swift 30 seconds at the end of the day. And I think it's important for us just to stand up and move around so we're fully focused and concentrating on the last 2 presentations. So everyone take 3. We'll start promptly at in 3 minutes. But yeah, let's stretch legs. Thanks. because it helps me then ask the right questions when you're coming to do the commercial advice.
So you do commercial advisory for like large scale?
Yeah, project developers, investors, a lot of work with government. So we're supporting government on BRF 2 at the moment. Kind of commercial advisory service to help perform. Yeah. Yeah. Yeah.
Do you want everyone on stage now?
Run up. You can do it like.
Do you want to run up or do you want to run?
Yeah.
You're gonna have a comedy entrance. Comedy entrance. Comedy entrance. Yes. Like Boris Johnson.
Hi everyone. We'll just take seats and get started again for the afternoon. Sounds like it's going to be a really high energy session, which is I know what we need on day 2 of a conference. So day 2, last session of a conference. So that's fantastic. Look, really delighted to invite Adam Blumquist to introduce the panel today, where we'll be really diving a little bit deeper into some of the themes that have been discussed already to date, in terms of how we do think about navigating those O&M challenges through some more cutting edge solutions. So I think a lot of the themes that we've already talked about today around digitisation and innovation, this is a chance to kind of hear a little bit more from some experts in the field. So thanks so much, Adam and panel.
Thanks very much. Wonderful to see you all guys here. And we've got a fantastic panel and we're going to fire some things up this afternoon. So thank you for joining us. I'll ask the panel to give us a quick overview of a one-liner on where they're from. But I think what's really interesting, one of the key themes that we want to talk about this afternoon is, we've heard a lot about, how do we manage some of these assets? We've heard about how we connect them into the system. Yeah, as we've talked about, there's some digitization, but we haven't really come across, what does it really mean? What does it really mean? And we're trying to keep assets running properly, making sure they're future-proofed and making sure they're viable for what a full two-sided market economy is going to look like. So I think there's a lot of things that we can look at here. And what does it mean for increasing the reliability and resilience for understanding our grid utility size assets? And what I loved about this panel is we've got a bunch of different perspectives coming at this with some really interesting stories. So I'd like to sort of welcome our panel. So we have David Barshevsky from Meteo Control. We've got Nick Engerer from Solarcast, and we've got Josh Birmingham here from SMA Solar. And of course, online, thank you for joining us, Carlos Lopez from GRS Australia. So maybe we'll start with Carlos. Carlos, could you give us just one line on who you are, what your role is, what brought you here today?
Okay, good afternoon, everyone. Thank you. I'm sorry for not being there. Weather restrictions. I'm Carlos Lopez. I'm the managing director of Grand Solar Group here in Australia. We are effectively a company that one of the divisions does EPC and O&M. So we build roughly more than 110 plants globally, roughly 3 gigs. In Australia, we have 10 projects. Right now, 4 under operation. So that equals to 360 megs. Tech.
Brilliant. Thank you, Carlos. David.
Yeah, I'm David Barshevsky. I'm the managing director of Meteo Control Australia. Meteo Control is the longest independent monitoring and data for solar PV, and also in Australia for stationary storage. We've been around 22 years. We're running 60,000 assets all around the world of 21 gigawatts.
Fantastic. Thanks, David. Nick.
Yeah, Nick Engerer. I am the CTO and co-founder of Soulcast, and we do weather forecasting for solar assets. That's the one liner.
Okay, that's good. Just straight out there. Josh.
So Josh Birmingham, I head SMA's large scale and utility business for Australia. SMA are pioneers in power conversion technology, 40 years in the business, over 7 gigawatts installed or committed in Australia. Yeah.
Fantastic. Thanks, Josh. And I should probably say I'm Adam Blumquist, the CEO and co-founder at RedGrid. We create a transactive economy system using software for how we can create a flexible, multi-sided market in DRs in the future. So thanks for joining us, guys. I want to kick off here with one word. What is each of you to give me one word, and what is the biggest challenge that you see in O&M right now for the assets that you're managing? What's the one word that's the biggest challenge? Let's start with Carlos.
Remote locations.
And I'll take that with a hyphen in the middle. We'll make it one word. So yes, remote locations. Fantastic. Thanks, Carlos. David?
Cost
of
O&M.
Yeah, fantastic. Nick?
I'm going to say longevity. It's
Okay.
it's a word I like. For
It's a
many
good word.
reasons.
We're going to dive into these in a minute. Yeah, great. Thanks, Nick. Josh?
I'd say collaboration.
Okay, the biggest challenge. Okay, fantastic. So what I'd like to figure out now is thinking about those words, and I'd like the audience to sort of hold it in mind. What do you guys think is the biggest one word of the challenge of what we're facing here? And we'll talk about this at the end of the session, but I'd like to think it's 2030 and we're looking back. We've had 8 years looking backwards. Maybe David, like with Medio Control's vast sort of array of technologies out there already, if you're looking back from 2030, what does the world look like right now? We're sitting here, it's December the 8th, 2030. What does it look like? What have we overcome? What was the opportunities that we really grasped to get here?
So in a bigger context, I think 2030 will look different. Like everything will be electrified. We're going to see much more distributed generators. So not just solar farms, we see a lot of rooftops, and Australia is leading this in residential rooftops. We're going to see a very fast market, and we're going to see probably smaller players in the market as well.
So what's the biggest challenge we overcame? Like, how do we get to that? Lots of smaller players. Is it deconstruction of bigger players? What does that look like?
I think we're going to see smaller players because it's becoming a distributed market. We can call it's decentralizing. It's going more to the distributed, it's more distributed, but it will be much more challenged to coordinate it. Now, if we think about, 10 years ago, there is a power station and the power flying from the power station into the load. Today, when we start to introduce solar, wind, stationary storage, EVs, the energy will start to move. It start to be distributed. It will be very hard to predict. And that's where innovation will come into a play.
So complexity is going to be one of the biggest things we've got to overcome.
For sure.
Yeah, okay. Sure. Josh or Nick, any thoughts you've got on this, kind of looking back from 2030? What do we overcome? What was the biggest barrier that then, and looking back and seeing what it is like today in 2030, how does it look like from your perspective, what you do every day?
Look, from my perspective, 2030, we're at 100% renewables most of the time. So, we've had to overcome all of these issues around system strength. We've had to go through a massive transition with the grid away from large centralized spinning turbines, which are generating electricity, to a network of generators and consumers spread all over the country. What's the biggest challenge going to be when it comes to that? There's so many, and we're running into them so quickly. From SMA's point of view, it is that transition to an inverter-based grid where we're no longer relying on coal and gas and large spinning machinery to give us that system strength. We're getting that from inverters. Honestly, I think that may actually happen before 2030, but that's where we're going to be.
An inverter-based fabric of the grid. Yeah. Nick, thoughts?
2030, we're talking about 2 terawatts of solar, in my view. We're on a doubling trajectory for solar as an exponential style technology of around 3.5 years. We will see coming from around 700 gigawatts getting to a terawatt very soon within the next 3 years, and another doubling again to the end. And that is happening because solar is being deployed at every scale, and it is now almost in every market. So the economics of it as it matures, a great example being the rooftop market here in Australia, where you can get 5 kilowatts on your roof for $4,000. You say that to somebody in the United States, their jaw drops. It's amazing what can happen when that market matures. So that is the style of uptake we will see, the level of pricing we will see, and it will be innate. Solar will be powering all sorts of different technologies beyond just straight up electricity on rooftops. It'll be powering, you got the hydrogen conference next door. It will be breaking down. It'll be part of the generation of hydrogen fuels, as one example. It will increasingly enter the transport sector, mostly through charging electric vehicles. And so the solar being everywhere, and then decision-making on when some of this stuff will happen, how it will happen, will be increasingly informed by the availability of solar, which is what my company does. So I think it's a very good decade ahead.
Happy times at Solcast. Carlos, what are your thoughts? Looking back, you're sitting there at 2030, you've just jumped on and you're like, okay, cool. What have I found? What am I enjoying
Well,
right
I
now?
guess that I agree with my colleagues. You know, solar is going to be everywhere. So it's an exciting decade to be. But I would love to see or to acknowledge that we have increased exponentially our efficient, how we operate and maintain the assets. That is going to be a very big topic today, right? About how we do things differently in an efficient manner without or with not as much as we have right now with the human intervention factor, trying to do things operating remotely, because there's going to be plenty of solar. That's no question about it.
So why don't we actually jump into that then, Carlos? Because imagine if it's 2030 and we're looking back, I'm imagining there are some really amazing flying robots that are going to be cleaning all of the solar panels. And look, it's 2021 already. You know, we've all got supercomputers in our pockets. Don't we have robots already? I mean, like, what's going on, guys? Why don't we have the robots to clean all the solar panels?
Okay.
Carlos, what do you think?
Well, I'm sorry to be the bad news bearer, but if you go to our site today, you won't find too many robots, to be honest with you. You will see a lot working 8 hours a day, operating on my so sorry, guys, that's the realities of today. We are in December 21, and we still rely on human and on people to run a solar farm, okay? Run a solar farm, and it's still not being cost effective, to be honest. I do agree that one of the biggest challenges is still the cost. You know, there's a lot of pressure from our clients. This pressure goes downstream to everyone, and we need to be efficient. So yes, there is a long way to go and a lot of things to be done.
Can you comment, Carlos, on, you know, we hear a lot about machine learning and artificial intelligence in this. How far away is the first forms of this machine learning to help with O&M as you see it?
Well, see, effectively, things have improved a lot, right? Now you have like let's say an O&M building or a control room there, where you have systems, automatic systems that tells you on basically on a daily basis if there is a difference between strings or inverters production on any particular area of it's not behaving as expected. So that facilitates a lot the operation on a daily basis. So you send basically your guys to that area, see what's going on, fix it, or you are in permanent contact with your inverter supplier if needed. Things have changed as well. It's like car service, right? So they tell you have to change the oil every 10,000 kilometers. Right now, you know, my colleagues from SMA, they send you like a plan in advance and tells you, hey guys, please don't forget to change your filter and X that day. So you do that in advance. So change has changed a lot, right? But one of the things that still I love to do is in O&M, the killer is the corrective maintenance. So that's really what makes that costs you a lot of money, and that means cost for the operator, revenue for the owner. So this needs to change or needs to be improved, right? And our approach there is that a small investment in construction is a high saving on during operation. So having reliable equipment, robust equipment there, best approach in design can mean a lot of money during the lifetime on an asset. So that's the kind of mentality that needs to happen. The more that we avoid the human factor on that equation, the more efficient we are going to be.
So with that, what about my colleagues here? Any comments on that around where you see data streams coming in to help with this corrective maintenance or to help increase the net asset value?
Yeah, I'm sure. I'm happy to speak to that, and particularly sitting next to David here, whom we quite away on that, because one of the most important factors in the performance of a solar facility is how bright the sunshine is at that facility, and knowing if it's been a cloudy day, how the weather has impacted the site, whether or not there's been snow on the panels, et cetera, is one of the first steps you need to go through in preparing data to go through advanced analytics. So you have to be able to separate the main driver, the environmental conditions, from the behavior of the plant to then go do the analytics to determine things like, is it performing correctly? And I would say more generally, on the topic of AI and big data, that what has only just started to happen is the availability and the ease of use of large scale cloud computing. So that's what we use to drive, we process 6 terabytes of satellite imagery a month now on the Amazon Web Services cloud. And something like that would have cost an order of magnitude more just 5 years ago than it does now. And so the ability to be able to achieve that price point, for it to be affordable, to look at big enough data sets, terabyte scale and bigger data sets, is really important for machine learning. You need to be able to hold that data, move it around, and then you need to be able to expose it to really large instances with large amounts of memory to do the machine learning process itself. And that's another thing that's changed in cloud computing, is that you can spin up flexible instances and bid for time and do all sorts of fancy stuff that you couldn't do 5 years ago with cloud computing now. So you can hold the data and you can process the data in the cloud at increasingly affordable prices. That's what enables the machine learning algorithms to access and play with the big data. We're only at the very start of that. But the nice thing about computational costs is that they're following Moore's law, and the same thing goes on with the price of cloud computing, and that's coming down. So we're only just starting to see the beginning of what's possible. What I like about it is that the cloud data sets that we build will always be a part of that. But you will get increasingly toward this future that Carlos was mentioning, which is where there will be fewer humans involved because we'll have smarter and smarter systems. And increasingly, we will be able to use artificial intelligence, meaning machine learning algorithms, to pull out those signals.
So what's the so we're going down that route. We're still at the early stages of this, Nick. Like, from David, from your perspective, like what is happening right now that's setting the scene for this? Because it sounds like we've got guys out polishing, and cleaning the solar panels, but actually we've got a lot of data that we could be using, but we're not using.
Yeah, that's correct. But at the same time, I must to agree with Nick here. We're just in the beginning of the journey, and big data and cloud computing, and it's becoming more available and much more economical. And the approach, and echoing of what Carlos just said, is the cost of labor. We need to move the cost from the labor and put it more on the machine, when the machine is helping us, to concentrate on the immediate task. Also to help us to evaluate the cost of the maintenance versus the benefits. We need to start to look at this data before anybody on site pick up a screwdriver or a bucket to clean up the panels.
Yeah. So there's a whole.
That's the big great example that I see time and time again is, can we avoid rolling a truck? Because we can tell you, no, your system's not underperforming. It's just been 2 really cloudy weeks in a row. That cost of the labor is so important in this cost saving equation. We heard it from our previous panel this morning. We're talking about the costs side and the revenue side, and data can play on both of those sides of the equation, therefore improving the economics of solar and helping us with that ambitious 2 terawatts that I called for by the end of the decade.
And this is really interesting, right? Because you're talking about data, but you're talking about visibility and understanding of what is happening in the system at any one point in time. And we still, in the behind the meter component of everyone's electricity use is super invisible still. Like, we're working on that to understand how to improve that visibility so we can have a much more dynamic two-sided market. I want to jump to you, Josh, and to sort of twist the conversation into really how can this data help us in understanding system strength, and can you talk us through a bit of a cheeky story that you've got that really outlines this challenge that we've got with system strength and systems operability?
Emphasis on the cheeky.
Yeah, as cheeky as possible. Cheeky because it's a lot of money, basically.
Look, this relates, I guess, to the West Murray issue, which has been a big one for SMA over the last couple of years. John Cole touched on it actually in the previous discussion. And look, again, it sort of goes back to this whole point on collaboration and optimization of assets. West Murray was a set of 5 solar farms constrained to 50% for over 6 months. We're talking roughly $500 million worth of assets. We caught wind of this probably 3 months before the market did. And it was a late night phone call from AEMO through to our team in Germany.
Sorry, it's not an algorithm. It's not a robot. It's nothing. It's a phone call of a human being saying, "Guys, we got to tell you what's going on here."
Correct.
Yeah.
This was some modelling that they'd done, which produced an oscillation, which produced an instability that they had to address. And they came to us and said, essentially, "Guys, how do we fix this? We've got a problem here. What do we do?" Within 2 weeks, SMA had 2 of our top engineers on a plane sitting in AEMO's office in Brisbane. And it took us 3.5 months to develop this, analyze the data, work through, massive amounts of data to find out what was going on. And then what we managed to do was provide a firmware-based solution. So, and again, John touched on this earlier, this avoided tens of millions of dollars of infrastructure costs that would have had to have been spent, all through smart analysis and collaboration to provide this outcome for the existing solar farms.
Oh, and you mentioned collaboration and as one of the key barriers here. So why is collaboration so hard? Like, is it humans the problem? Maybe this is the thing we keep going back to. I don't know.
There's all sorts of competing interests, right? And a lot of the time, I think it's just where we are as an industry as well. Like, we're still early days. We were actually talking yesterday, trying to make an iPhone comparison. Are we at the original iPhone, classic iPhone 3 yet, or are we still playing Snake on our Nokia, 3310s? And I think that's probably where we're sitting at the moment. We talk about big data and we talk about this analysis, but right now we're not properly capturing that data, and we haven't really established the correct data points to capture. And until we start doing the basics right, then we're not going to have that underlying data to fully realize the potential of machine learning and of AI.
So the basics. So you really think we're still playing Snake? We're
not far off it.
Yeah. Okay. Yeah. Okay. Really interesting. So Nick, maybe this is a good way to jump to you on this. So we, thinking about those data points, thinking about, how do we, what is the basic level of data that we need to do some of this stuff, and what's the upside? Where's the ceiling on this? I guess there's no ceiling, but what do you see as the next few years of where this could go?
Yeah,
and if you want to pitch that to
so I've got some audience engagement activities today, and I have these lovely keep cups with the Solcast logo on them. And what's going to happen is I have 3 of them, and I'm just going to throw them into the audience. So please be ready. I don't want anybody to get hurt.
You've all signed waivers, right? If you're really
upset you didn't get one, go see Alistair. He'll give you one. I don't want anybody's feelings hurt. And I'm going to do the first one right now.
And
okay. And I do remember the question.
Yeah, great.
Okay.
And now
Good.
the person who's with the
Enjoy
keep
the keep cup. All right. We knew it was 3 p.m. We're pushing 4 o'clock.
Yeah,
on the
there's
last
going to
day
be
here,
more
guys. All right,
things
so,
thrown out to the audience as
I've
we
got
go
2 more
through.
where that came from. Okay, I'll give you a warning. Look, this question will be viewed through the lens of who's the decision maker, right? It'll be different. It's going to be different for the example we just talked about with AEMO. It's going to be different for the asset manager. It'll be different for the owners. It's different for the O&M holder. Everyone needs to have the data they need to make a decision to fulfill their obligation to their client, to their stakeholder. So if you look at it through that lens, again, one of the things I find very convenient about our company at Solcast is that one of the unifying things that everybody is going to have to start caring about is how sunny is it now? How sunny will it be in the next few minutes, the next few hours, the next few days? Because what's happening is we're headed towards 2 terawatts of solar. Everything's going to depend on the sunshine. And so this is a real unifying factor. And what I expect looking forward, and I'm already starting to see some of this in South Australia, where we're working on a project where we're giving AEMO and South Australia Power Networks and Snowy Hydro and Energy Australia, we're giving them all access to load forecasting that includes the impacts of rooftop solar, that is based on real-time tracking of cloud cover and near-term forecasting of cloud cover from 5 minutes ahead through the first 4 to 6 hours ahead. And we're also doing utility scale wind and utility scale solar forecasting. And we're giving them all of this data, because what's happening when you get to 50% when you get to 50% penetration of rooftops and you have several gigawatts of wind and several gigawatts of solar, and you don't have much fossil fuel generation, you don't have any big coal plants, you got a weak interconnector, that is what the future looks like. It's this diverse mix that has to be settled, and it needs to be decided on an ongoing basis what the solar resources going to be, what the wind resource is going to be, the total supply and demand balance, how that's going to look. It's all continually depending on the weather, not just the solar, but the weather. And as Mike Davidson, head of operational forecasting at EMO, has been saying for a couple of years now, is that the weather is our fuel. That's the future. The weather is the fuel. And so in that decision-making space across all those different folks I mentioned earlier, the weather and solar irradiance and solar power forecasting and solar historical data and solar real-time data is a unifying factor in that space. And what I think is really cool is it will start to inform how we orchestrate these different resources. It'll play a part in how virtual power plants behave, how these large-scale batteries and small-scale batteries behave. And that will be decided within the broader mix of understanding what the energy market is going to need, which is increasingly influenced by the weather. And we're doing that in Australia before anywhere else in the world is, particularly in South Australia. So we have a real unique playground here where we get to really lead the way. And I go to conferences around the world and they care, and they're very interested to know what we're doing here in Australia. So that's a roundabout way of coming to the answer, saying it's a little bit different for everyone, but I see some commonalities. And the biggest commonality that I see through my own worldview is, of course, that weather data.
Yeah, fascinating. And there's something there you're touching upon, the weather data is going to be so huge upon a huge influence on how we understand how we can manage this network, how we can have DSOs running this properly. I'm thinking then through to what does it look like in terms of the fabric of smart inverters that's going to have to be here to manage this? Because the weather is the fuel, the inverter is the combustion chamber. Like that's the bit where it takes place, something happens. I'd like to call Josh on this. Like, what I see, what's fabric of inverters? Maybe first.
Well, for me, I mean, in utility scale solar farm is different, right? So utility scale solar farm, we are relying on the majority of central inverters, and the amount of data we're getting are massive. But the majority of that, and I do agree with Josh, the majority of this data goes directly to the inverter supplier. So they got a real data on site about what's going on, and then we communicate with the system and vice versa. So it's for us, machine learning and data means trying to anticipate two things. The more that we anticipate, the more efficient we are going to be. It's as simple as that. So if they're gonna have an issue with an inverter, that is a key element in a project solar farm. If we know that in advance, we will avoid having impact on our availability guarantee. Of course, that's a contractual obligation, and of course in revenue. So the more we know, and the more in advance we know, the better. Okay, that's key, and this is truly happening right now. Okay, it's truly happening right now. But I guess that all this machine learning, and if the equipment is able to forecast and predict the future on that end, on when it's going to have an issue, there is something on the grid affecting your project as well. That's going to be key as well for the owner, and that's an element. Bear in mind that battery storage is going to be here as well. There is also a huge amount of penetration of battery storage that it's going to change a lot of the equation that we got to mention. Is going to be much more key, on that end. But Josh, I hand to you.
Yeah, Josh.
Look, it's interesting. I think there's a few elements to that. So from an O&M perspective, the ability of that fabric of inverters to monitor, inform, and direct the operation of the solar plants, I think that's really key. But I think also it's key to future-proofing these assets, the ability to access future revenue streams and to behave in a flexible manner when the network demands it. So be that dealing with a system strength shortfall, like we helped Edify out with in North Queensland earlier this year, or be it responding to the challenges of the South Australian market, like is is going to occur with the AGL Torrens Island project. It's going to be about building in that flexibility, but then also looking at the installed base and optimizing the operation of that installed base.
So when we're thinking about, Nick, you mentioned about Australia being the playground to test out some of this stuff and looking around the rest of the world. Where are we falling in this area of the fabric, the smart fabric across the grid? Where are we falling behind, and where are we really far ahead? Like, where do we sit in the barometer of other innovation around the world on this?
This is a question to me.
It's a question to all of us. Yeah. So Nick, why don't you just go first, and then we'll jump around.
Sure. Where are we ahead? We are ahead in, look, you mentioned the Australian energy market operator and flexibly working with SMA to solve a problem. I think that we are ahead with the perspective that they bring, and that team, particularly in operational forecasting that we work with, bring. And they are seeing this important narrative emerge around how the weather is driving the energy mix, and it will continue to do in the renewable space in the future. And when I go to conferences and speak to the equivalent or the independent system operators in the US and Canada, the ISOs, they are looking to AEMO, who often come along to those same meetings, and saying, what are you guys doing? Tell us. They want to know. So that what we're doing in the energy market space and operating our energy market is a world-class thing in my view. And that includes this 5-minute ahead self-forecasting space, where we offer technology that allows large-scale solar farms to look ahead to the 5-minute ahead spot market that they have to send a dispatch value to. Otherwise, they get penalized and have to pay through the ancillary services market by a cause of pace factor for those forecasting errors. Even that level of engagement from renewable generators is world-class. Now, that's only happening on the 5 minutes ahead here because of the structure of the energy market. It happens on other scales in different parts of the world. Might be 15 minutes ahead in India. It's a day ahead in the United States. But what happens when you have more renewables is that time horizon has to come shorter. So we're ahead in that respect as well. In terms of where we're behind, I don't know that I can speak to that very effectively, because everywhere that I'm working is at that front part. I think it's possible to say that we're behind on the overall adoption of renewables and reducing our carbon intensity as a country. But that's down to the fact that we've just been burning dirty coal for a long time, and that's a legacy. We're not going to be there for long. With the economics, I've already spoken.
Yeah, great. And David, what are your thoughts on this?
So renewables, it's a global market, so it's a little bit to be ahead. But a good example is here on the stage, where we are ahead. Meteor Control team, our partner with Solcast, and we took Australian technology for forecasting. And I think our biggest market is Japan right now. So yes, we got good innovation. We got good engineers. We got also unique landscape for renewables. If you look at SA, penetration of renewables, how many days they're running just on renewables, system strength, we got some environment that will be different to model on a large scale anywhere in the world. So that's where I think that we are at. Where we behind, and that's very hard to say. We're missing a centralized planning area or body that will help us to collaborate. Right now, Carlos running his own grid connection and probably other developers. And we don't have a centralized body like in Europe that will help us to plan through this most important part is how we integrate to the grid. So that's where I think we're behind and ahead.
Yeah, and it loops around the connection between the machine and the collaboration between the entities to make sure this is actually working. Yeah, fantastic. So I want to spend the last minute before we open to questions from the audience for each of our panel members to I'd love to hear what you think is coming over the horizon in the next couple of years that you think about every day, but other people wouldn't be thinking about. So what's interesting, what's coming over the next 36 months that is really fascinating to you, that gets you really excited, but most people don't even know is happening. So maybe we'll start with Carlos. Do you want to jump in?
Yeah, sure. I mean, just to give you an idea, 85% of the cost of the O&M project is basically personnel, it's staff, labor, right? So all of you are driven to try to cut down this cost. How do we things in a different way and much more, let's say, automatic? You know, not maybe flying robots, but the idea will be at least trying from a centralized point of view, being able to operate and maintain remote solar farms, remote projects on an efficient manner.
Yeah, great. Thanks, Carlos.
It's
Yeah, so just that automation's coming, but it's exciting, but it's not quite here yet. Josh, what do you think?
Look, I think it's really just going to be evolution, right? I don't think that we're going to see huge changes from an O&M asset management perspective. But I think we're going to see a constant evolution towards assets that are operating more efficiently and actually living up to their potential.
Yeah, okay. So we got a lot of headroom there to go. Nick? Okay, who's going to get it? Here we go. Get closer. You got free keep cups.
Yeah. Oh,
yes. 10 points.
Right, that's that American football arm right there. Yeah, right. Quarterback to the wide receiver, touchdown. All right. So what's coming that others aren't paying attention to and will be a big deal? I see countries around the world who are aggressively adopting renewables, particularly solar. This is the Solar Energy Future Australia conference, but they put a lot of different letters on the end of this as they travel around the world with this conference. And that's because this is happening everywhere. And as it does, as soon as you get to around 1% to 2% of your load, depending on solar, you need to start including a solar forecast in your load forecasting process. And so, a great example of this is Taipower in Taiwan. I went and saw them in 2018. We've done a contract with them since then, where we're now forecasting for all their utility scale solar sites. And this is a small island with lots of convection and challenging cloud conditions. And there's a dialogue there. It's not simply we send you a forecast. It's they learn the process of understanding uncertainty, and that during the monsoon season, the forecasts aren't as good because weather forecasting can't predict thunderstorms well ahead of time, full stop. Like it's just still an unsolved problem to do that much more than a few hours ahead in the whole weather forecasting space as a whole. So there's this process of learning about uncertainty and how that envelope of uncertainty widens when you start having renewables in your grid. And that education process of learning and sharing between different grid operators and countries and regions to help each other move along that journey of operating in a world where there's more uncertainty. It's not just the plant's there or it's not because it's down or it's having maintenance. It's the plant's 20% there now and it's going to be 60% there in 2 hours maybe. That whole process of education and knowledge sharing between different organizations, particularly to developing countries, is something that is underway, will continue, and is the backbone upon which this transition will be built. Because if we can't balance supply and demand, then renewables can't keep growing. And the reaction that is the tendency, and it's a human tendency, is to say, oh, no, stop that. That's weird. We don't want that. Well, that's new, that's uncertain. But what I continue to see is these legacy institutions that we like to poke at, make fun of a lot. I see the people in those organizations stepping up and saying, we'll figure this out. We'll go through the hard work. We'll learn from others to make it happen. And that makes me optimistic, Adam.
So the wave is coming and we've just got to learn how to surf pretty quick. And the people in those organizations, that they want to start paddling, but we just got to help them do it.
Yeah, I love the surf analogy. The Byron Bay in me is happy.
I'm glad I'm throwing in there. There we go.
Yeah, thank you.
Awesome. Thanks, Nick. David, what are your thoughts? What's over the horizon that you're really excited about that most other people are just not thinking about?
I think what we need to pay attention right now, as we renewables will start to grow and become bigger percentage of the mix, that will come with a great responsibility. And what we need to start to pay attention that with responsibility, it's important that we will be on top of the problems to come instead to follow them and try to fix them. Yeah. So a good example as a leader, and we looking ourselves as the next energy market or the energy mix, renewables, wind, solar, batteries, EVs, hydrogen, hydro. As we become a greater part of the mix and fossil fuel will start to reduce their portion of the mix, we need to educate what's the right thing and what we need to pay attention in operating a very, very changing, evolving, innovating energy market or energy generation, and set example or best practice to whatever will come after that.
Love it. That's it's like you're sort of saying we here, the people in this room, are kind of like the Jedi of where the future is going to be going, to like govern it and to, you know, enable it to be as powerful and amazing as possible. But with great power comes great responsibility. Yeah. I'm just basically saying you're a Jedi, I think. Look,
what kind?
Yeah, exactly. A good kind. A good kind. So look, I think this is really what's happening, right? We're in this massive state of flux. We've got all this technology that's coming in. We've got tidal wave of DRs and different technologies coming through. And yet there is still these collaboration, these human problems we've got to get over. And some of it is education. Some of it is the ability for us to just trust each other and work together. So really fascinating points. I'd love to open to the audience for questions for the panel, please. Are there any questions?
Yeah, good questions.
Question at the back. Question in the back from Mary.
Oh, that's a long throw.
Yeah. Okay.
Hello.
Mary, you want a cup? Keep cup?
No. Thanks, Adam. I really enjoy your moderating and the whole panel discussion. You know, it's full of energy. So I like to ask you a question. I know, like, we had a conversation, and you mentioned that you want to bring your company and solar into space. So may I ask you, like, what's your plan for your company next 5 years? And also, Nick, I have a question for you. Your Apple is very good, you know, for how to say detecting the solar energies created, you know, not in space. But I'm wondering, like, you know, astronauts in the space, can they use your Apple?
Well, yeah, sure. Thank you, Mary. So space and material science expert. Thank you for asking that question. So RedGrid was created and named as RedGrid for a couple of reasons. The first reason is we think there needs to be a revolution. We're going to help galvanize that revolution in clean energy. The second one is that we thought if we're good enough, maybe we'll be the energy player on Mars. So we called it RedGrid because we use very highly advanced cryptographic approaches to how we understand security and privacy on DER asset integration. So that's why we thought we'd be going on Mars to do this. We're not quite there yet, but it is in the planning. Nick, pass to you.
Well, Adam, I've already committed to you that we will be the first solar forecasting company on Mars.
That's right.
I'd already thought of this before we totally nerded out about it.
Yeah, so, that's true. So,
you know, I've got a general idea how it would work. And, you know, unlike on planet Earth, where clouds are the major issue, it would, of course, be the aerosols and it'd be the dust. There are some Martian clouds, very high in the atmosphere, very thin. But it would generally be the aerosol problem that we'd have to nail down. And I think it's going to be important for our increasingly autonomous exploration of Mars and the ability to generate solar. Solar will be the predominant fuel source on Mars for the habitats. So to your question about space and astronauts, there's no clouds there. But the main thing that matters is whether or not the sun and the Earth is in between them and the sun, which is very periodic and easy to forecast. But if they come up with a problem where they need me to solve it and they ask for solar forecasts in space, I will absolutely do it. That sounds awesome.
Yes, thanks, Nick. Because I think that your technology of analyzing can definitely put it into Mars because there's no air. So there's no, you know, there's no complex analysis of air, the flow of air. Yeah.
I love it. I think solar energy futures in space is the next one that we'll be going to, which I think is,
there you go.
Look, it's legitimate. Thank you. Thank you, Mary. Yes.
Hi, my name's Sasha. Thanks to the panel. It's been a very interesting discussion. Carlos, you were speaking about the takeoff of regional areas. And I was wondering if you had anything more to say about that. Are there any projections for how long it'll take for the asset management costs to become less prohibitive in regional areas?
Thank you for the question. It's a good one. The challenge about remote areas is basically that you don't have access to services, right? Or expert services. So it's, for instance, you have an issue with one equipment and you need to send a technician, takes a long enough time, takes time. This time means cost, means money. So that's something we are trying to improve through having faster volume technicians being qualified by for instance, the relevant inverter supplier or from the tracker, whatever, to try to avoid to bring people to the remote areas. That's one path. The second thing, as I said, is trying to implement some sort of automation, like basic things that you won't imagine, like mowing. Mowing is becoming a huge issue in remote areas because the risk of bushfires. So being able to do automatic mowing and remote mowing from here, from Brisbane, that saves a lot of money. So the idea will be our approach and our roadmap for the future is trying to reduce 20% of the labor on an operation project in the next 12 months. So labor cost in Australia, as you know, is quite expensive. So, but is the only way or the only area that we see a massive improvement on the short term.
Thanks, Carlos. Any other questions from the audience before we wrap up? Yes.
Just a question about this remote support business. Do you guys ever think about having relationships with people that are already supplying remote support for farms and mines? People like diesel maintenance people, farm machinery maintenance, hydraulics maintenance, people that are already in the area and already got reasonably smart tradespeople there already.
It's a really good point. And I think there's a lot that the solar industry needs to learn from existing industries and how we maintain our assets. And again, it's a product of the fact that we're a very new industry, right? We work as closely as possible. A lot of the issues that we have are really around labor availability. Finding people in remote areas, particularly skilled people, is near on impossible. And I would say as an industry, what we should be looking to do is target skilling people up in these remote areas. And through collaboration, that's one of the ways we should definitely be looking at doing that.
Carlos, do you have any other answers on that one?
No, I mean, I agree. Mining is, to be honest with you, are miles ahead on that end compared to solar, and miles ahead, right? So yes, we're trying to engage with the local people in these particular remote areas, but the biggest challenge, as Josh has pointed out, is to find skilled people there. We're talking about areas that are maybe have 100 people population. Access are difficult, communications are even difficult. So basic things like internet connections are not the best there, right? So we have even an issue of a solar farm that lost revenue because we couldn't communicate properly. Forget about what we were talking about, machine learning, so on, 5G, 4G. I was talking about 1G, so we were not even able to have proper communication. So that's an issue. That's a real issue. That's what I'm saying, that mining industry is much ahead of us, and we should learn. And definitely is a very good point. We are a very young industry here in Australia, and collaboration and trying to engage by these services right now is going to be fundamental to bring the cost down here as well.
It's a really fantastic point to finish our session on, a really aspirational point, saying, we've got a long way to go, but we are at the beginning of this exciting journey. And I'm really fascinated to see how we take this forward. So thank you, guys. Can you please join me in thanking our panel for a great discussion?
Well, thanks so much, everyone. I'm glad I used to be a lawyer in my former life, but I'm glad I'm not one anymore. So I didn't have to worry about the risk of the flying coffee cups. And I'm sure we all really enjoyed that kind of sci-fi story. We had hoverboards, which was a bit Back to the Future. We had some surfing. We had robots. The thing I did have to think about when we're talking.
Hello to Oliver, Matt, Andrew, and Ryan. I believe I have seen you all online here. If I can get you to all pop your cameras on, because we are about to start your session. And I'm going to quickly pin you all. I'm going to start, Oliver, if you could just turn your mic off and just say hello and let me know where you're calling in from.
Oliver, I'm calling in from up in Gippsland in Victoria.
Amazing. I can hear you and see you well. Matt, can I get you to do the same, please?
I'm Matt Harper. I'm calling in from Vancouver, Canada.
Amazing. And Ryan, if I can get you to do that as well. Ryan, can you hear me? No, I'm still trying to check. Ryan, are you able to unmute yourself and say hello? Ryan, you're just on mute. And then Andrew, if you can turn your camera on and say hello for me as well.
Yeah, it's Andrew here. I'm unable to turn on my video because you've turned it off.
I've turned it off. I have not turned it off.
But the host has turned it off.
Oh, yep. So you can start your video yourself down in the bottom corner. And Ryan, are you still having trouble unmuting yourself?
Yeah, so right now I'm in fact focusing on the battery storage.
Hi there, Matt.
Oh, yep. Andrew, I can see you perfectly. And Ryan, we just still...
Okay, can you hear me now? Is it okay?
Oh, yep, I can hear you all now. Perfect. I'm going to pop you all on screen because we are ready for your session.
So I was still managing director of Suntech Australia for 4 years. So as you can see that I got a background of both solar and battery. So I think I should be able to add some points for this specific topic. Thank you.
Fantastic. You do look a bit lonely up there. So if you're struggling, just wave and we'll send some eminent members of the floor up. So if anybody's interested in contributing, let us know. And Oliver, we have our virtual panelists available now, which is fantastic. Oliver, I'll pass over to you to introduce yourself and the other panel members. Thank you.
Thank you so much, and thank you all for joining us. I apologise, I'm a little bit casual today. In Australia, we've been in lockdown so long that that when we get an opportunity to do an offsite, particularly in Victoria with a new business, it's incredible to be able to get together. So my background is I'm the CEO or ex-CEO I was inaugural CEO of the Clean Energy Finance Corporation in Australia. I'm a board member of the Smart Energy Council, which is the industry leading body in relation to solar. And I recently started a new business, which is called Sentient Impact Capital, for which we're having our first offsite today and actually meeting staff. We only built the business with virtually for the first time now in Gippsland. So to give you a bit of background on the new business, as many people would know, having been at the CEFC just focused on reducing emissions. This new business, which is Sentient Impact Capital, which currently manages about $220 million, has been set up to not only invest in transactions which reduce emissions, but also transactions which protect biodiversity and nature, and also invest towards transactions that deliver a greater social equality. So it's a specialist impact investment opportunity. We're trying to show people that the return that you get when you invest should not only be measured in percentage, it needs to be measured actually in relation to the return that you get, both financial return and the return you get in terms of positive externalities. So I'm delighted to be here today. The topic for today is effectively integrating battery storage into solar plants. Certainly, batteries are the game in Australia, from my understanding at the moment, and from what they're being integrated, or people are integrating them into existing plant, particularly as we're seeing almost low prices during the middle of the day. Merchant players are desperately trying to find out how they deal with systemic low prices if they don't have long-term offtakes. And in addition to that, we're seeing many other batteries being applied, not only at larger levels within the grid, but also within the home. So with that, we have four speakers who'll be introducing themselves shortly. Scott Ryan, who's joining us. Scott is from Empower. We've got Andrew Dorman, who's the chairman and founder of Yalama Energy. We've got Matt Harper, who's the commercial officer of Invinity. And obviously, I think I think that might be the right way to pronounce it, but I'm never sure. You're head of energy storage at Sungrow. So what I'm going to do, if that's okay, is ask you to introduce yourselves and then speak. Take the time to explain the areas that are important to you, and then we will come back with some questions for the panel, and then also follow on with some questions for the floor. So if I can start off with the first panelist, and we might break this up in a little order so that it's not just us all virtual. We might start off with you, if that's okay. Ryan, would you like to start off and go first?
Thank you very much. Great to be here, even if it's only virtual, and apologies I couldn't make it down there today. I'm Ryan Scott. I'm the general manager of Empower. Empower is a technology-led EPC business. We focused predominantly the design and delivery of critical power systems, and more recently renewable energy systems. We've been delivering grid-connected small utility-scale solar farms in the NEM for the last few years, and over the course of the last 18 months to 2 years, we have kind of changed direction, and we are now focusing on the development of projects through to an operating status. So Empower is now moving into the build, own, operate space, and opportunities in the Australian market at the moment. A lot of changes are happening, and we're looking forward to taking advantage of those.
Thank you. Should we move on to, if that's all right, Andrew? Do you want to introduce yourself next? And if you finished, have you finished there, Ryan?
I can go on a little bit more if you like, or we can wait till some questions and dive into some more specifics. Happy to.
That's fine. So Andrew, do you want to introduce yourself, please?
Well, yes, indeed. I'm calling you from London today, London, England, that is. I'm a long-term investor in renewable energy. I've invested in wind and solar and biodiesel, and now getting into the battery market in Australia. I'm very enthusiastic. I've looked at solar investments in Australia, and quickly realized, of course, that all the problems that Australians have with low prices at midday, and I know a number of panels have previously discussed this point. So it became very obvious to me that if we were going to make money in our investment in Australia, we would need to add some sort of storage system. So I spent quite a bit of time looking around the world really for technologies that would work. I'm a long-term investor, so I like to see long-term returns from any renewable investment. As I looked at the lithium option, I became very concerned about the short lifetime, short number of cycles that you can achieve from a lithium battery system. And replacing the batteries every 5 years did not seem very attractive to me at all. and would require, sort of constant managerial oversight, new investment. Appreciate completely that lithium batteries are coming down in price all the time, as are other technologies. But nevertheless, I was really looking for a longer term investment opportunity. Second big issue for me was that, I appreciate that what South Australia really needs, and potentially the rest of Australia and elsewhere around the world, what is really needed is medium duration battery storage or storage technologies. Medium duration storage technologies is a much narrower set of options. Anyway, as part of that investigation, I came across, of course, vanadium, which I'd been following for a number of years. Vanadium redox flow batteries are what we eventually ended up choosing for the Adlamarca development in South Australia. Vanadium has some very attractive features from an investor point of view. First of all, the medium duration. As a flow battery, essentially, you have 2 bathtubs of electrolyte, and those bathtubs can be as big as you want them to be in theory. And so that really determines the lifetime, or the duration. That determines the duration of the battery power that you have. We chose 4-hour batteries for the Adlamarca development based on extensive modeling of the South Australian energy market. And we looked at, 3-hour batteries, we looked at longer term batteries. It turned out that probably at the moment 3 hours is about optimal. But we went for slightly longer duration because we felt that the midday reduction in prices that time period was probably likely to extend as more and more solar comes on board. So we were looking for something that was 4 hours plus, really. Vanadium fitted that bill very nicely. A number of really attractive features of vanadium for me. Second one, of course, is the expected lifetime of vanadium. And the lifetime really, as I understand it, is dictated mostly by mechanical factors. So pumps, things like that, which have to be replaced on a cycle, a maintenance cycle. But the vanadium electrolyte itself does not degrade. So even 100 years later, that vanadium oxide is going to be just as useful for storage as it was on day one. The mechanical aspects around the battery, of course, need to be replenished and replaced as time goes by. This gives you a really great exit option also for vanadium, which is that you can recycle that vanadium oxide into new applications. And obviously there are a lot of industrial applications of vanadium. So you have a residual value that comes from exiting. A third factor, which was important in our decision to use vanadium, was that there are no recycling problems. It's non-toxic. Lithium, of course, has all sorts of issues associated with it. Extracting the lithium at the end of the lifetime of the lithium battery is not easy. I've actually looked at a number of investments actually in lithium recycling, which look quite attractive, actually, given the rising cost of lithium around the world. So those 3 factors, I think, were very important. I mean, if I could add a couple of other factors. One, vanadium batteries don't set themselves alight. There's no fire risk from vanadium batteries. Disadvantage of vanadium is that it's less dense. The energy density is lower than lithium. So it depends a lot on your site. We chose a site north of South Australia in the outback where land is essentially free. And so, the fact that the vanadium batteries come in containers, and there'll be, in our system, there'll be 41 containers. That was not a material factor for us. So that made the decision pretty straightforward. When we looked at the economics, we found that in terms of levelized cost of storage, that we would break even with lithium investment probably within around 10 years. So if we paid full price for these batteries, the break even versus lithium would be around 10 years. We were lucky enough to obtain support from ARENA, which has supported us to almost 50% of the cost of the vanadium batteries. And one of the reasons for that, which was, if you like, the final reason why I was really enthusiastic to support vanadium, was that vanadium is one of these emergent technologies that is going to benefit as it scales up. As manufacturing scales up, the cost of these batteries is going to go down very markedly. And as part of our submission to ARENA, which we did in conjunction with Matt Cooper, Matt Harper from Invinity. As we put this proposal together, Matt and his team were able to demonstrate to me and importantly to ARENA that the cost of vanadium batteries would indeed be coming down by around 50% over the next couple of years, with known opportunities to reduce cost. There are further opportunities to reduce cost, of course, which come from further research and moving from sort of small format batteries to larger format batteries and so on. So all in all, I'm an enthusiast. I wanted to invest in this partly, if you like, partly for commercial reasons. It's a fully commercial project, but also for social reasons. I think the vanadium batteries were identified or invented, if you like, in Australia at the University of New South Wales. Vanadium is widespread in Australia. It's mined in Western Australia today, and there are a lot of other opportunities for mining vanadium. This is potentially, really a hometown technology for Australia. And if we get behind vanadium and scale it up and help Matt and his team scale up vanadium, this is a really major opportunity for Australia to get into electrolyte production, to get into battery production, and to use vanadium batteries on a widespread basis around Australia.
Well, thank you, Andrew. That was a bit of a long introduction, but we'll get back to more detailed questions. But thank you for that. I mean, I think it's very exciting. But so on that note, given that Matt, you're up next and you're involved in that project, I'm sure that you can expand on that and introduce yourself and your firm and talk about the exciting cost advantages of vanadium. But more importantly, at this stage, if we could just have a brief introduction, we'll come back with more specific questions around the economics, because I know people are very excited to trying to work out how we can make storage sustainable, cheap, effective in a land and a country such as ours, where the resources are available. A solution like this seems actually made for the Australian environment. So Matt, over to you.
But between your introduction and Andrew's introduction, you guys have already said all the good things. It doesn't matter what my name is. You guys have already nailed it. Look, I'm Matt Harper. I'm the co-founder and chief commercial officer at Invinity Energy Systems. I'm coming to you today from Vancouver, Canada. Invinity, as you guys all now well know, makes vanadium flow batteries, in particular for application to renewable power projects. I've been involved with the technology originally in an engineering capacity and now sort of on the commercial side of our business since about 2005, and founded Invinity in 2013 with the goal of taking the vanadium flow battery technology, which was reasonably well understood in industry, but making some adjustments to how the product was actually delivered that made that product very much fit for purpose for the solar industry in particular. Since 2013, we've now deployed the largest fleet of flow batteries that's ever been built. We've got 300 some odd of these individual battery units out there and operating in the field. We're using that fleet to prove the capability, not only technical capability, but also sort of the commercial capability of these batteries. And as we'll get into in some of the Q&A, are sort of looking forward to demonstrating in Australia the ability for this technology to take abundantly generated solar power and deliver it back onto the grid when it is most valuable.
Terrific. Thank you, Matt. And Mr. Wu, would you like to introduce yourself as well, if that's okay? And then we'll come back to some questions for you all.
Actually, I think I have done this already.
Okay. Okay. Well, then what we might do, if it must have been while we were offline and you were there holding the audience's attention. Thank you. Yeah. Thank you so much for doing that. But if we could, whilst we're on you at the moment, given Sungrow's global knowledge and given all the macro global outlook that you see, where do you see the whole battery market going at the moment and solar adoption? And how fast, how much, and can you talk through what you're seeing from your industry's perspective in relation to, the pinch points and the demand and supply issues that the industry, as you see it, is facing? I mean, I know in Australia there's a lot of issues going on in relation to the source of batteries and the supply of batteries. That there are real questions both in relation to panels and batteries now, and I think it'd be great for our audience to understand what are the supply constraints that you're seeing in this industry, given from the volume of batteries we see coming into Australia, it's absolutely extraordinary. The pipeline, if it ever got built, would be absolutely massive. So supply, I think, is something we'd all be extremely interested in understanding whether it is an Australian phenomena or whether this is absolutely a global phenomena, which is only going to exacerbate the supply issues.
Right. I think currently there's some supply issues. People in the industry all know about that, but from my perspective, it's still a temporary thing. It's because of a couple of different things. The majority of the production capacity for solar and battery are still in China, as we all know, and China just right now has some issues of power supply, and because of pandemic, some shipping issues, kind of things are together. So that's why we have some temporary supply issue at the moment. So it is forecast for batteries, the price will, I'm talking about the lithium battery because for the vanadium have not that much of knowledge. So, but for the lithium ion battery, its forecast price would increase by 20 to 40% for the next couple of quarters. But like I said again, I think from my perspective, it's still temporary. In the long term, the battery cost of battery will still going down if we're talking about the second half of the next year. And in terms of the market size, I'm trying to do my best, but what I can remember is that for solar, I think for this year, the worldwide capacity will be something around 130 gigawatt. That is for solar. And for next year, I think its forecast capacity will be something around 150 to 170. That is according to various different market forecast agents. So as you can see, that the market is still expecting the size of solar market still gonna grow, but still that's the positive thing about it. But but when we talk about the demand, we need to consider the supply as well. And if you have a look about the Bloomberg New Energy Finance Report, the aggregated production capacity of all tier 1 panel manufacturers, it has already been something around 150 gigawatt already, sorry. So, and then the total capacity of the panel to 300. In that sense, from long-term perspective, I would expect the panel price will continue to go down, which is a good thing for the industry, for solar industry. In terms of for Australia, I think this year, as a lot of us have known already, this year our solar capacity is something around 5 gigawatt, of which the residential behind the meter segment is around 3 point something gigawatt. So it's about 2 gigawatt. It's going to be from large scale solar farms. So next year is predict something similar to this. I think that's the solar situation right now. But as long as the battery is concerned, this year, the total capacity worldwide is around, I think it's 12 gigawatt hour worldwide. Australia is about 1 gigawatt hour. But we expect significant growth in the battery segment. So in the next 2 or 3, I think 3 years, it is expected the total battery capacity will grow by 3 to 4 times by 2024, 2025. That's what will happen in so in the next few years, battery capacity increase will get to about around 4.5 gigawatt hour. So that's a significant growth for the battery segment. Yeah, that's my perspective. I mean, there's a lot of opportunities for us, but a lot of companies are working on that. So the demand is strong, but the supply we're working on that. So while for the term might be some challenging, but for long term, I wouldn't worry too much about it. Thank you.
Thank you so much. I mean, I might flip to you, Ryan, if I could, because you're facing the market, if you like, and I think what was just mentioned there was, you know, a potential, if I heard it right, of batteries, you know, rising between 20 and 40%, which for lithium batteries, which is a scary prospect. I'm in the industry at the moment with people trying to build solar farms, and they're having difficulty securing supply. Container costs are absolutely through the roof, so delivery is becoming a real problem. For you in your industry as a build, own, operate EPC specialist in both, you know, solar and solar storage, they must be big issues for you. So I was wondering whether you could talk through that for everybody on how you manage projects, because managing projects with that type of cost volatility becomes quite hard to bank. It becomes quite hard to finance. In particular, if you could go into detail where you see the hybrid PV, you know, BESS DC coupled systems fitting into in the mix. So could you take us through that from your perspective? Because I think that's what would be extremely interesting to see as an EPC provider, how you're coping.
Yeah, absolutely. Thanks, Oliver. Yeah, you're absolutely right. The market at the moment is very challenging from both an EPC perspective as well as a developer and an asset owner. We're seeing costs across the board going up for various reasons. We've got external pressures coming from supply chain, material commodity prices have been increasing. Everyone's aware that PV module pricing has been, has really risen sharply recently, and we're still expecting that to continue probably until at least the end of Q1 or into Q2 next year. The shipping issues, shipping prices are 4 times, 5 times what they were on average prior to the pandemic. And all of this is, really colliding and making it a pretty difficult environment at the moment. I think we do see a lot of those challenges easing as we head into 2022 and onwards, especially as we, the global manufacturing and supply industry moves past COVID, or at least the major impacts of COVID. But even with all of those pressures, even with all of those challenges, we still see the Australian market as being attractive. We still see significant opportunities in the Australian market as an EPC and, as more importantly, as a build and operate developer, EPC asset owner. And a lot of that is around where we see the market going in Australia and being helped along by some of the recent rule changes that have been being pushed through and being brought through. We've all seen the recent final rule determination from AEMC on the integrating battery storage into the NEM, and we see those changes, especially around the new classification of the integrated resource provider, opening up a lot of new revenue streams for the smaller utility scale hybrid systems. Empower is focused on a portfolio approach. We're looking at building 30 or so 5 megawatt solar farms across Victoria, New South Wales and South Australia. And all of those are being designed and developed with batteries in mind from the outset, and many of those will be built and delivered as full hybrid systems right from day one. And the changes we're seeing with the ability for DC coupled battery storage system and solar PV plans to find new means of revenue with the ability to arbitrage, deal with this significant midday PV penetration that we're seeing, especially from behind the meter residential and commercial PV pushing down minimum demand. The ability to shift that generation to later periods in the day. I think that's very much what Andrew was talking about around the use of vanadium batteries in South Australia with their significant negative pricing periods. Take that generation and move it to a different time of the day, and that's one area where energy storage integrated with solar generation is a real focus of ours. But also, once the rule determination is brought in and the NER is updated, we're going to see the ability for these DC coupled PV battery storage systems to start participating in ancillary market services, to revenue stack, and really change the financial model around how we look at these. And that's really Empower's focus. We see having a distributed portfolio where you're distributed from a geographic perspective and removing single weather issues, single network issues, and really taking the best bits of that PV generation, battery storage, and the ability to operate in multiple different commercial markets within them we see as a real promising future.
Thank you. I think that's great. Look, on that note, I might quickly flip to Matt if I can, because what you're seeing here, and I see this tension in the market really at the moment, and I know we believe it's temporary, but the kind of national reliance issue, or the ability to source domestically in relation to vanadium, the less price volatility we're seeing in that sector, and the volume of storage in Australia. I'd really like your comment on it, because it was mentioned by Mr. Wood that basically 1/12 of current battery demand is coming out of Australia, and Australia is rather a small country, to be honest. But to be pulling that much demand, it means it's pulling outside its weight. If you're seeing battery prices going up and supply issues increasing, how do you square that? How do you square that circle and create an opportunity for Invinity? How are you going to maximise in that? I mean, Andrew was indicating that he thought that the economics was 10 years away, and that was because of falling lithium prices. I guess if you're seeing lithium batteries rise by 20 to 40%, that must be coming closer. Talk us through the economics that you see and the rationale you see for someone actually adopting a vanadium battery solution approach here in Australia, and why it is potentially a unique market from that perspective.
Sure. Lots to unpack there. One thing I think, and Andrew, correct me if I'm wrong on this, but I think when you talked about a 10-year time horizon, you were talking about the investment time horizon over which you're looking at the investment, not that we're 10 years away from having positive returns for our class of technology. I think that we're already today pretty competitive in the right kind of applications for our batteries, in a number of different markets.
Yes, Matt, if I can just come in there. Yes, absolutely. I was looking at it from an investor's point of view. If you believe as an investor that you've got an asset that's going to be a 25-year asset, which most solar farms would be put in with a 25 to 30-year perspective or expected lifetime, then it's clearly superior to move to vanadium over lithium, right? And the break-even point, if your solar farm only lasted 10 years, you know, under the current economics, which I appreciate are moving around, but let's just say 10 years for a moment. If you believe your solar cells would only last 10 years, then you might choose lithium. But if you believe your solar cells are going to last more than 10 years, say 30 years, then the economic choice is absolutely straightforward. You would always choose vanadium.
Yeah,
Andrew,
and then
can I just jump in there? People are doing grid connected batteries where obviously it's not even relevant to the solar farm, and maybe you can answer this, Matt. But obviously the life of the battery is infinite. You know, you have a piece of land on which you can create storage. It isn't the solar farm it's related to, it's basically attached to the grid. Is there a reason why we're not seeing 100 megawatt scale vanadium projects getting underway in Australia, where we're seeing massive lithium battery projects get connected to the grid?
Yeah, look, I think it's really simple. You know, technologies or classes of solutions have a certain degree of momentum to them, right? The storage projects that we're building today would have been the biggest lithium storage projects in the world 6 or 7 years ago. You know, and as our market is maturing, you know, there is a realization that there will be horses for courses in the storage space. You know, lithium has done a phenomenal job of proving that batteries can be profitable on the electric grid. But, you know, as we look beyond sort of shorter duration or lower cycle applications to need to take renewable power and duration asset, you know, like what Andrew was talking about, you know, 20 to 30 years, you know, that's when, you know, lithium doesn't perform as well, and where technologies like ours can come into play. You know, the example that I often use is, and especially speaking of sort of supply constraints, you know, so much of the demand for lithium batteries today is coming from the automotive space. You know, and we look at the automotive space a lot because it presents a view of, you know, what the long run evolution of, you know, the lithium batteries are going to be. If you think about what the automotive industry views as, you know, the panacea for lithium batteries, that, you know, everyone talks about the 1,000,000-mile battery, right? Well, a 1,000,000-mile battery, and you know, the automotive industry says that, you know, we may have that sometime between 2025 and 2030. A 1,000,000-mile battery, 100-mile vehicle, implies 2,500 charge and discharge cycles. 2,500 charge and discharge cycles, when you're regulating solar power, is less than 7 years of service. That's not an asset that is going to be fit for purpose for delivering ultra low cost, ultra reliable power of the sort that we've gotten used to from fuel-based generating assets on the electric grid. If we're going to displace those fuel-based assets, we need assets that can step in and make renewable power dispatchable, that have that same sort of asset life that the renewable generating capacity also has. That's where our technology steps in.
So sorry, Matt, I might be a bit dumb here, but you know, there's 3,100 megawatt, and maybe you can throw the answer to this, Andrew. There's probably about 3,100 megawatt battery projects going to be dumped on the grid around Australia. You know, imminently, they're all going to be lithium, right? And who knows whether they'll get there? They may get heads blown off with increasing prices. But I haven't heard one of them being vanadium. And, you know, I think it's really important that, you know, given where we are at the moment, you know, if you could explain to us why, if you're saying that, you know, that the costs are competitive, particularly if you're looking like a long life asset, give us the 5 reasons why, if it's commercially attractive, people would put it up. Give us the 5 reasons why you think people are not doing it.
Sure. So, I mean, the first one that I would jump to is, you know, just the question about, you know, maturity of the technology, right? You know, companies today out there building renewable energy projects or storage projects, they understand lithium, they know it well, it's well proven. Their engineers understand how to integrate it. You know, it's a fait accompli. You know, the old expression, I don't know if you guys have the same thing, is, you know, no one ever got fired for buying IBM, yeah. Right? I mean, it's very similar. There's momentum that occurs. You know, as we build out our project with Andrew and some of the other projects that we're looking at building, you know, we think we're going to start to take a bigger bite out of that world. The second, you know, factor that I would flag is that is that technologies and markets, well, sorry, let me put it the other way. Regulation tends not to advance in advance of technologies, right? You know, regulation and market structures evolve in response to the technologies that are available and proven for the electric grid, right? If you look at it on its fundamentals, you know, there are a number of reasons why you would want to design market structures around our batteries rather than others. You know, Ryan, you mentioned value stacking, right? You know, if you can take a battery like ours that doesn't degrade based on cycle life and stack incremental amounts of value onto one another so that that battery is dispatching into 2 or 3 different markets in a particular day, you know, that is just adding incremental value. That's not something that's particularly easy in some of the, you know, the way the markets are currently structured. There are impediments to being able to serve those multiple revenue streams all at the same time. And, you know, with conventional lithium batteries, there's not a lot of impetus to remove those because you're paying for your batteries using sort of the first and most important source of value you're getting out of it. There's not a lot of desire to stack incremental applications onto a lithium array because every time you cycle it, it's one cycle closer to death. I'll give you 2.
I do, Oliver, sorry, I do think there's also just a misunderstanding or a misapprehension in the Australian investment market, which is that a lithium, you know, a 1 hour lithium battery is going to be really, really helpful. A 1 hour duration lithium battery is actually not going to solve the problem of time shifting energy from, you know, the peak production period from 10 a.m. till 2 p.m. every day to the 7 p.m. peak requirement market. You know, it's just not going to get us very far. It's a contribution, obviously, but as I think we know, a lot of the lithium batteries are actually really earning most of their income from FCAS support, which vanadium batteries, I might add, are just as capable of doing, and we will be, you know, revenue stacking in the way that Ryan is suggesting. But you know, Australia needs medium-term batteries, and I think so. I do think there's a misapprehension problem here about what is the nature of the problem in Australia.
Okay, well, look, we might have to, I'm not sure where we're up to in terms of time, but I think we've got about another 10 minutes would be my guess. It'd be an opportunity here for anyone to add to a little conclusion if they like, if they've got particular things they'd like to have to wrap up. But you know, from my perspective, I'm extremely interested, and I think everybody in the audience would be extremely interested to fully understand this value difference, Matt and Andrew, and I think anyone who's a developer in the industry wants to understand if there is an alternative to lithium. It is not an alternative that's well spoken about in the market, and I think most people would like to be provided with an economic cost comparison, because we are seeing lithium batteries 2 hour, 4 hours, you know, coming into the grid at significant scale. If it is purely investors' comfort with the technology, as my understanding, this technology is not that complicated. It is a chemical process, so it's not that complicated. So I would hope that you'd be able to break that down. But you know, everybody here in Australia the whole industry is gunning for more storage because it'll allow more renewables to come into the market. It'll deal with the crippling and very low daytime peak pricing. So the opportunity in the market is immense at the moment. So I think you're in an ideal position if this can work, and everybody will be gunning for you and supporting you, and that even still complies with, you know, the idea of even larger lithium batteries coming in. So let me just hand it over to you for a couple of minutes each, if you could, in case there was a final comment, and I'll start off with yourself, Mr. Wu, if you had any particular comments that you'd like to add to that discussion before we pick up questions from the audience.
Well, I just want to say that Sungrow as a company, we are a battery solution provider. So we are especially specialized in the whole system integration, and also we are strong with our LED power system technologies, well, PCS inverters. So in that sense, we are actually battery technology agnostic, which means we can use battery cells from this lithium-ion battery supplier on that battery lithium-ion battery supplier, and theoretically we can use other technology as well. So that's us. That's what we provide. And what I'm trying to say is that, and topic of this discussion is about solar, how battery can support solar for the long run, and that's an interesting topic from what I can see. So, because in the last few weeks, when we talk to the solar developers, or investors or other IPPs in this industry, a lot of the customers, potential customers, have been have talked with us about their concerns about the return of the solar farms. As Oliver just mentioned, that there are different aspects that contribute to this, because of the curtailment, because of negative pricing, everything. And that's actually where our battery solution can definitely help. But just that sometimes some of customers are even talking about changing their traditional solar inverter to some sort of battery ready, or we also call DC couple enabled battery, the PCS or inverter, so that they can add the battery in the future. All right. Right now, I think that what they are struggling, what we have found that our potential customers, what they are struggling right now is still about the financials. So, and then they are concerned about the potential loss from their solar farms, but still they need to plug in our financials to make sure that systems work. And a lot of times they're still struggling, because the numbers show right now it is at the edge of we could do that or we couldn't do it. It's at the edge. But from my perspective, as time goes, and like I said, in the long run, the battery price is still going down, and also it's still going down, right? So in that case, it will make the financial much better. And also, what we can find from variable repositories, right? And the in the Australian market, if you study the IMO data in the last few quarters, you will find the we call it arbitrage opportunity, which means the discrepancy price between the peak price and low price is getting bigger and bigger, which means the arbitrage opportunities is getting bigger and bigger. So in that sense, that's why it is forecast. I think that's real opportunities. We have that investors' eyes. So I think that's really well we as a battery solution supplier that can help. I think that's really well the fundamental of why we have those opportunities. Thanks.
Okay, thank you. Ryan, do you have any last parting comments before we head to the audience to pick up any questions that they have?
Yes, I think what everyone's talked around in terms of the need for longer term storage on the NEV is absolutely right. I think there's no one single solution when it comes to integrating storage into the network. Australia needs large amounts of very fast response storage for grid stability, for synthetic inertia purposes. It also needs longer term, arbitrage-based systems, and they have a unique ability to provide that. I think we've looked at flow batteries of various types over the years, zinc bromine, vanadium, and they've been around, especially the zinc bromine systems in Australia, for quite a number of years. And I think the only thing that's stood in the way has been price point. And I think, as Matt said, it's about maturity of that technology. But I think that there's still a way to go to get to a level playing field with lithium, even when we do consider life cycle. I think that we absolutely are moving towards a scenario where all variable renewable generation is going to be built with a storage element. I think we're just at the precipice of where the price point for that storage becomes, a no-brainer. At the moment, as Wade said, it could work. It might not. It might be the right time. Might not be the right time. I think we're very, very close to that point where it's an absolute no-brainer, and all solar generation projects will have co-located DC coupled energy storage.
Okay, thank you. Well, that's fantastic. Now, Matt and Andrew, I'll just finalise with yourself shortly, and then we'll pick up the questions from the audience. But what you're suggesting is that there's a more sustainable battery solution, much more sustainable environmentally, available in Australia with Australian technology that's ready to go. You're indicating that the only reason why people are not doing it is because they're unfamiliar with the technology, but the technology is reliable and proven. Give us your last 2 minutes as to how people would be able to easily assess your battery, because as Mr. Wu said, Sungrow's happy to run any battery. They're not set on lithium. They can choose any battery, and so would be the same with Ryan. I'm sure if the price was competitive, he'd put any battery in there. Give us 1 minute on how you convince us that you can do it. I mean, I know what Elon Musk would say: give us 100 days, and I'll deliver it cheaper than a lithium battery. Can you do the same?
We can certainly deliver a lot more capability out of a single box than what some of those other solutions can do. The ability to deliver it out of Australia with a lot of the materials is really key. The ability to participate in some of those different, both short duration, ultra short duration, and long duration applications that Ryan was talking about is absolutely key. And you stick those two things together, and you've got a solution that is going to pay itself back far faster than any lithium array.
Okay, Andrew, anything from you, or we'll take questions from the audience and then wrap it up.
Well, just as an investor, I would just add one other point, which is that the cost of capital today is at record low. Lowest it's ever been.
So if you can't make it work today, when are you going to make it work?
Well, I think that's what investors, need to be really thoughtful about. What is the sort of time horizon that they're investing over? With low cost of capital, you can easily invest over, with a 25-year horizon. You don't need to have a short payback. Lithium certainly gives you a short payback, but vanadium, given the current cost of capital, vanadium is really a more attractive choice if you have a long-term view.
Okay, terrific. Well, why don't we see whether there are any questions from the audience, or otherwise we'll say our farewells and wish people well, but let's see if there's any particular questions that are coming from the audience, if we could.
This is a question for Hugh specifically. My name is Danny Wilkinson. I'm a project development manager based in Australia. Currently, I'm developing battery energy storage systems independently, 100 megawatt plus in Victoria and New South Wales. Just a question that, and actually it's more of a concern that Andrew raised about lithium ion being able to be, risk of fire essentially for an investment point of view. From my understanding, it's based on the chemistry, and probably for you from Sungrow, do you have a preference in what chemistry you use? And what is that?
Yeah, I think, and it definitely you're right. There have been some fires, but based on our analysis, most of the fires that happen, they are from companies. I don't want to mention the names, but their technologies has been mainly the NCM, which is lithium, cobalt, and magnesium. So that is totally different technology compared. It's also lithium ion, but it's a totally different sort of lithium ion battery technology than from what we are using. We are using the AFP, which is different technology. And the AFP, the NCM is mainly previously being used for electrical vehicles, and AFP, that's what we are using right now, has been largely used in the battery storage solution. From Sungrow's perspective, last year we have been supplying battery system for the next 6 years. Last year alone, we have delivered 800 megawatt hour of battery system, and so far we haven't had any accidents in the last few years. So we're pretty sure. It's because of the technology we use, also because of the fire suppression systems we have been adopting as well. So we are pretty much confident with the product and solution that we have been providing to our customers. Thank you.
Any other questions from the audience? I can't see there in Melbourne if there's not many people charging up to the stage. We've almost reached our
Andrew. Oh, two more.
One more, yeah. Two more. There we go.
I understand that the vanadium technology is not very space efficient. What's the outlook for that becoming more space efficient and any residential applications?
Sure. So first of all, we don't look at residential in particular. Certainly, there are other companies who are interested in that space. It in theory could work. It's not part of our remit, but it is potentially possible. You know, the nice thing about the technology is because it has no fire risk, you can install it in a residential environment, you know, comparatively easily. There's a lot fewer permitting restrictions that you would face. On the space density, yes, it's true that, you know, when you look at sort of a single battery unit, you know, a vanadium flow battery is probably 2 to 3x the size of a comparable lithium array. The difference is, again, because there's no fire risk, you can stack, you know, containers of these things on top of one another and put them immediately alongside one another, you know, instead of the sort of, you know, the widely spaced out installations you typically see in a lithium array. That means that the project itself, by the time you calculate sort of the full number of acres that you're going to be installing over, is kind of roughly equivalent on an apples to apples basis for the given capacity.
Thank you.
Yeah, and just one last one for Ryan, if you don't mind. Ryan, you mentioned that you're developing some 5 megawatt projects with DC coupled batteries in Victoria and New South Wales. And I'm just concerned, not concerned. I'm interested to know that at a transmission level, say 100 megawatt plus, would you still introduce the same concept, or would you have the batteries on the AC side instead?
We are particularly focused at that 5 megawatt size for a number of reasons. You know, many of those are to do with the connection requirements and the compliance requirements with AEMO. If we were looking at larger PV systems at that size, I think that the benefits that we see around DC coupling probably are not as obvious. I think when you're at that sort of size, a separate standalone co-located AC storage system would probably be the way to go. I think it's horses for courses. There's different benefits to a DC coupled system to an AC coupled system, and it really depends on what the asset owner is looking to achieve from that system. For us, it's smaller scale and it's DC coupled. I think for very large 100 megawatt plus, I think it's probably going to be AC coupled as we've seen currently in the market.
Maybe I can add some points on that as well, because we have been talks to different customers. Some of my customers are developing some big solar battery projects, 100 megawatt and plus, and they're all on the transmission lines. Most of them customers would, for this kind of the battery projects, they would consider mostly AC coupled solutions. DC coupled solutions has been very rare. It's not from technology's perspective consideration. It's mainly from financial perspective, because for most of these projects, they still need to have the direct access to the network service market, FCAS and voltage regulation, everything. In that sense, they need to have a separate connection. They have to apply for the grid connection separately in order to have the access to the market. So in that sense, the DC coupled solution doesn't give them this flexibility to do that. So that's why at this point in time, for most of the bigger battery projects, most of them are still AC coupled independent battery solutions.
Yeah, I might say that our project in South Australia is a single connection, DC to DC, connected. But where we've been working is around the inverter. We've actually scheduling the inverter to optimize import and export has really been one of the key focuses of our work, and I think quite innovative, really. We certainly will have one connection which will be multi-purpose.
Yeah, and the testing that we've recently done to prove that we can, go through the battery into the inverter, full swing from charge to discharge in 52 milliseconds is definitely a big vote of confidence in the ability of this device to serve any particular application.
Very good. I think any other questions, or we might have to leave everybody there. I can't see anyone racing up. So look, thank you all so much for today. It's extremely interesting discussion. Australia is going to be obviously a huge user for batteries as we pull away from the fossil fuel fleet. The alternatives and opportunities to use Australian-made technology are obviously evident, and I wish everybody luck in getting their systems into the market. And given all the complications that people are facing as developers and EPC constructors at the moment, I think the sooner the market stabilizes down post-COVID, I think it'll be better for everyone. But thank you so much for joining us today, and everybody there in Melbourne. I'm sorry I can't be with you, and I really enjoyed the conversation. Thank you.
Thanks, Oliver.
Thanks, everyone.
Thank you, everyone. Bye-bye.
Bye.
I'm not going to keep you long. I'm sure you'll agree with me that it's been a really delightful and insightful set of conversations we've had today, and had the privilege to hear. I set out to learn a lot, and I think I certainly have. I've got a notebook full of notes and a lot of great conversations in this room and out of it.
You're now not live on screen.
What really stands out to me as we leave today is that we can't and shouldn't try and separate some of these issues from each other. When we think about O&M, we think about digitization, customer outcomes, some of the themes that have come through around financing and commercial outcomes, the operation and maintenance of these assets is really integral to their long-term viability, which is obviously very clear to everybody in the room today. And as we look forward to that future where we're going to see more PV coming on board, I think that last presentation focusing also on just that idea that battery technology and energy storage is really going to go hand in hand with this next wave of investments, and see us through to that future of 2030. Whether or not the energy's on Mars, I think you'll agree with me that it looks optimistic despite the challenges. And so I'd really like to thank all of you personally for the contribution you make to the fact that as an industry, we've heard a bit about frustration, but what I hear is still a pipeline. What I hear is great progress being made. And I think everybody here today has played a part in that. And yeah, really look forward and excited to see what happens next. Thanks, everyone.